Good morning, every single body on planet Earth. It is Wednesday, July 10th, 8:46 a.m. Thank you all for being here. I'm going to have to disappoint. I do not have a stylish shirt today. Honestly, I need to. I asked my mom. I need to get more of those sunflower shirts. It's from Shein. She ordered it for me because a couple weeks ago we had a party at her house and the theme was sunflower, and so I don't even know where to get it from. I have to get the link from her, but I got to get more of those because the reception was great. So maybe for the rest of the summer, we just got to be wearing our stylish Dan Ives types of shirts. So there will be more shirts, but today, just a regular white shirt. This is going to be an exciting one today. We've got a lot to talk about. Sofi, Anthony Noto just had an interview on Squawk Box. I'm going to start off with that interview before we get into everything. I thought that interview was very interesting. Honestly, gave me a lot more clarity on what's going to happen with Sofi and why I think they're probably going to do better if we get a rate cut. I mean, that was the assumption that when there's more liquidity, they'll be able to increase their lending. But I want to watch that interview. That was interesting. What he said at the end was the most interesting. I've never heard a CEO actually say something like this. But we're gonna listen to that and see what he said. Number 2, we've got Jay Powell testifying again on Congress. It's going to be at 10 a.m. So about 30 minutes after the market open, we'll see kind of how that plays out and what he gets grilled on again. Yesterday was interesting, but we didn't really learn too much different from what we already knew. And then the stock market. Tesla's still 262 in the pre-market. Nvidia's up about 2%. Apple's up 0.39%. We definitely have a very green pre-market. SoFi's up 1%. Palantir 2762 up 0.82%. Now Bitcoin rallied to 59,467 last night. Tried to make a gun at that 60,000 range. And then it got shot down back to 57,920 today. But all the Bitcoin stocks did in the overnight markets have some fun. And they're up a little bit right now in the pre-markets, but they would be up more if Bitcoin was still at that 59,000 level. So we saw some good activity. Yesterday, the ETFs brought in another couple $100 million after $300 million on Monday. So it was really nice to see that the ETFs are picking up momentum in terms of Bitcoin. But overall, in the pre-markets, we have a pretty green market. S&P 500 right now is 557 in the pre-market. Look at that. If that holds, that's going to be our 37th all-time high for the year for the S&P. So we'll take a look at that. Any news about Palantir? No news about Palantir today. We don't have any new sort of Palantir news. The only thing that we have that I'll probably discuss later is we got a new blog post from them that's a little bit nerdy about how to stop hallucinations and LLMs, and that stuff's interesting, but nothing like big on the stock. One thing on the stock is there's no insider selling. Still no insider selling that's that dramatic. Yeah, like yesterday someone sold 3,000 shares. So I mean, that's what I'm seeing right now. But outside of that, dude, Karp, Sham, Peter Thiel, they're just not selling. And it's really nice to see that the stock is running up and we're really not seeing any momentum to the downside. Now, I know earnings is in a couple weeks, so they probably can't sell. But still, throughout this entire run, we really haven't seen too big of a sell on Palantir. Okay, let's start off with SoFi. And go from there. I really thought this was a very interesting interview. And what he said shocked me at the end. He was so honest. And I actually really admire it, bro. I really admire it. So let's get into Anthony Noto. Let's see what he had to say. And then we'll keep going from there. All right, here we go. Here's Anthony Noto on CNBC.
Before we talk about your business, I want to talk more big picture about the conversation here in Sun Valley, specifically about the state of the economy, given your purview through your business, as well as the conversations you've been having with other CEOs. What's your sense of the economy right now?
Yeah, I'd say the conversation really kind of pivots around 2 points. One is where's the consumer, how are they performing from a credit standpoint, and where interest rates going in the economy. On the interest rate point, we came out of Q1 having reported 26% year-over-year revenue growth with really no growth in our lending business, which is a really strong quarter, and we're really pleased with how things have gone since then. We've came out of that quarter thinking there'd be 1 to 2 rate cuts and positioned our business to do that, which would give us still attractive revenue growth, maintaining profitability, but just as importantly, having a strong balance sheet to take advantage of when rates go down. I think the consensus view is starting to come into picture, and people will believe we'll continue to get the data points on inflation, continue to see an uptick in unemployment, but not too bad, and we'll have 1 to 2 rate cuts by the end of the year, which would be really positive. As it relates to the consumer, we've seen really good trends in spending. We've seen really strong demand for refinancing personal loans as people are trying to lower their debt so they can make sure they're planning for the future. So overall, our company's performed really well in this environment. I'm glad we took the stance of lower rate cuts than everyone else, because it's positioned us now to benefit when rates start to come down. So I like how we're positioned. And for the first time, I'd say in 2 years, there's a more central consensus view about rates and where credit is. And credit actually has performed relatively well throughout the year. And that's something I heard from a couple CEOs last night. And we're really happy with where it's performed as well, in line with our tolerance levels and our expectations. So all in all, I think we're setting up for a pretty strong back half of the year in 2025 if we get the right fiscal policy.
Well, we're going to talk more about fiscal policy in a minute, but I just want to return to something you said. I know you've been introducing new things such as alternative investments, but also you mentioned you're not doing as many student loans. What is behind that policy, and where are you shifting your focus to effectively follow or lead consumers, and where you want to be growing the business?
Sure. As we came into 2024, there was a view that actually rates would be cut 4 or 5 times. And we believed that for rates to be cut that frequently, there would have to be a recession or some type of underlying problem. It turns out we'll get 1 to 2 rate cuts, which is where we've been positioned. And as we thought about the environment and thought about how much we invested in our financial services business, our Sofi Money product, our Sofi Invest product, our credit card product, as well as our technology platform, we had an opportunity to drive really strong growth there at 50% and really pull back in the lending business to be more conservative, to wait to see where the economy shakes out, where interest rates shake out. And now we're coming into a picture where that's a lot clearer. So we've delivered really strong growth without really using the lending business to help drive it. And now we're in a position where, as we go into 2025, to use both.
Now, of course, your business all started with student loans. And then just last week, a federal appeals court allowed a key part of Biden's student loan repayment plan to resume, staying in an order that had temporarily blocked it. Now, there's been a lot of back and forth on this, but how does Biden's efforts to repay student loans impact your business? And how do you see some of these legal changes and sort of the whole appeals process and the outcomes impacting your business going forward?
Yeah, we've really focused on people that have private student loans. Those are people that are still managing their cost and giving them cost savings on refinancing their private student loans. And that's been a smart strategy. It's a much smaller percent of our business. We gave guidance that we'll do close to $2.5 billion of revenue this year. We'll see really strong growth from the other businesses. So we're much less dependent on it. The fact that we grew 26% year over year in Q1 with no growth in lending overall is a great indication that we've invested in other areas that are really paying off for us. And the response that we're seeing for consumers in our Sofi Money product with 4.6% interest rate, Sofi Invest product, as you mentioned, offering them alternative assets and now IPOs, we've seen a great response there, and it's allowed us to go after other growth areas and not be so vulnerable to the whims of where the political or winds are blowing as relates to student loans. I will say this, we've done well with a high rate environment and uncertainty around credit. I'm really excited about what will happen when rates start to come down, and you can start to see the light at the end of the tunnel. When rates come down, we'll see a real pickup in student loan refinancing. Right now, there are people with rates at 7 to 8% student loans, but we only can offer them in the 6s. As rates come down, we can start to offer them in the low 5s and maybe in high 4s. So that business will pick up. Our home loan business had historically been a refinancing business. We've invested a lot in being able to do purchase home loans, and we're now seeing that pick up and gaining market share there. And we've recently made the decision on home equity lines to give people even lower cost of debt. So as rates come down, we'll see a real pickup, and as long as the economy is stable and inflation is stable.
So that's the bull case on Sofi. His argument's, hey, he'll talk about the stock in a second, but his argument's like, hey, when the rates get cut, we will win. And if you're holding on to Sofi and it sucks because you're down, if we do get 2 rate cuts, the CEO believes that is definitely going to stimulate the business, and the byproduct would be an increased stock. So the question is just if we get those rate cuts.
So you've mentioned various ways that your business is growing, but your stock is way down. Stock's down about 35% year to date, down about 19% since your last earnings report. I know that you have earnings coming up in a few weeks, so you're limited in terms of how many specifics you can share. But what's your message to investors? Why should they hold on when the stock is down so dramatically?
Yeah. The thing that we can control is our strategy and our execution. And for the last 7.5 years, our strategy has been consistent and our execution has been consistent. We've driven good, steady growth. When I joined the company, we had less than $300 million of revenue in 2018. Now we're over $2 billion of revenue. We weren't generating profits. We weren't generating positive EBITDA. Now we're generating both positive EBITDA and GAAP profitability. So I'm really pleased with what we're doing. In terms of the stock, I'm equally disappointed. I'm a big investor. Our employees are large investors. What we've seen and what we believe is happening is that the group of fintech companies that have credit exposure has been really hit hard, and they've been hit hard because of the uncertainty around interest rates. When will interest rates peak, and when will credit peak? And as I mentioned, we're really pleased with where credit's performed. We expected it to pick up a little bit, but it's within our tolerance levels. So good sign there. And as I mentioned, 1 to 2 rate cuts would be welcomed and moving in the right direction.
And what about AI? Will SoFi be the one to bring AI to retail banks?
So right there, you saw him say he's upset about the stock, but he's blaming it on rate cuts. He's basically saying, look, it's not our fault. It's not the company's fault. We're executing. It's rate cuts. And honestly, I mean, given their business is contingent on liquidity to issue more loans, and the loan side of the business is not growing as much because they're being more conservative, he's kind of right about that. And so if we get the rate cuts, his argument is like, hey, the stock will benefit, but we kind of need the Fed here to ease up.
Banking, and will that really accelerate your results?
Yeah, there's a whole spectrum of technologies that we use every day to ensure that our product is safe, it's reliable, and we can be a trusted partner. Where we want to use AI is to fortify those areas, but we also want to use it to answer 3 questions every day. Because this is a financial show and we operate in a financial world, people want to talk about interest rates and consumer spending. We don't spend a ton of time talking about the product, but we are a product company, and my vision for the product is that you open up SoFi every day and you go to your member home feed, just like you would to your Twitter home feed or your Facebook home feed or LinkedIn home feed, but we answer 3 questions for you in a personalized way. What must you do in your financial life that day? What should you do, and what can you do? AI allows us to take all the data about you and everyone else and answer those 3 questions.
Just a final question about politics, because I know the conversation about the presidential election is front and center here in Sun Valley. What outcome do you think would be best for the economy and for your business in particular?
Well, I'll make an analogy. I went to West Point and I played football, and I want Navy to win 364 days of the year. But on that one day when they play Army, I want Army to win. And so I'd be lying to you and being, less than disingenuous if I didn't say our business would benefit from a Republican administration. There's more capital markets activity. There's more M&A activity. I want our country to be very strong and vibrant. And on one particular day, I'll be rooting for one particular party.
Okay, well, we'll leave it there for now. Anthony Noto.
Dude, I did not expect Noto to say that. He said straight up, I'd be lying to you if I said a Republican administration would not help our business. And on one particular day, I'll be working for one particular party or voting for one particular party. So here's the question to the chat, and then we'll move on from SoFi. And while you guys are putting your answers, I'll give my other thoughts on the interview. Do you think that was a good thing to say? I'm assuming there's a ton of Democrats that also own SoFi stock that might just not like that the CEO is voting for Trump, and they might dump their shares, and he's probably isolated a bunch of people. But I think that question also, I feel like that question was rehearsed. I think if they didn't want him to talk about politics, they would have told CNBC, like, hey, don't ask about politics. Like, that's just not like what he's going to answer. But it seems like they were okay when they asked about politics. He had a prepared response, and he said, hey, I want Trump. I want Trump. So I have respect for it because he's being honest here, and he's just saying, hey, this is what would be best for our business. It also kind of feels like the stock has gotten to such a bad point and shareholders are so upset that at this point he's like, look, we have to get this stock to recover. Noto also does have like $500 million waiting for him in 2026 if the stock gets to $25. So obviously, whatever gets that stock to 25, people are going to act in their self-interest. And if he thinks a Republican administration that would stimulate more capital markets is going to create more liquidity, lower interest rates, which would get the stock to be at a higher rate, that's ultimately what he's voicing. I just didn't expect him to say that. I really didn't expect him to say that at all. I mean, that's a hell of a thing for a CEO to say straight up, even though we know a lot of these CEOs think like that, but it was very interesting. In terms of the other parts of the interview, I thought it was good. I think Noto crushed it. I don't think he was scared. I think he had strong responses. I think he was on his game. He sounded confident. He admitted that he's annoyed about the stock, which is really good. Sometimes when you're down so much money on a company, you just want people to relate to you, and who better to relate to you than the CEO of the company that you're down on? And so for him to say, hey man, I'm one of the biggest shareholders and I'm really upset as well, like this is not fun for me, it at least gives some solace to people that are down on the stock, and they know that someone's working really hard to try to get them out of that position. So I thought that was good. In terms of that last question about AI, I think this is where I don't believe Anthony Noto. So he says, I want you to open up your phone, your SoFi app, and have this 3 questions. How do you get your money right? What are you doing? What can you do? All answered in one cohesive feed. I think SoFi is far away from creating a product experience that is that beautiful and meaningful and engaging. I mean, he says we're a product first company. I disagree. I do not think SoFi is a product first company. If they were a product first company, the app and the product experience would be different. So from that perspective, I think that SoFi has to do a lot of work. But again, the app is a very, the SoFi Invest is a very small percentage of their overall revenue. The main revenue is lending and then financial services. So as long as rates get cut, it's really not that complicated. SoFi is going to have more liquidity. They're going to issue more personal loans. They're going to start growing even more. And they believe they're going to grow more without having massive credit risk. The reason they got downgraded yesterday is because KBW and Barclays believe they have some more credit risk. So I thought it was a good interview. And hopefully the market responds to it today. But earnings is going to be where they really show that they're getting ready for a rate cut to come on. And we'll see. Jed says, why is he upset about the stock? It's like listening to Peter Beck complaining about Rocket Lab, work on your product and innovate. Yeah, I resonate with this, but I do think it's good if the stock is down for you to like acknowledge the stock is down. Like, I think it's important, especially if you have a majority retail shareholder base. Like, they want to know that you're not oblivious to the fact that, you know, shareholders are down lots and lots and lots of money. And it's just even hearing the CEO be like, yeah, I know it sucks. I get it. I'm with you. I own a lot of shares as well. I think it is comforting. And I don't feel like he was reaching or anything like that. I thought it was a good statement. I thought it was a good segment when he talked about that. Honestly, it was a little Karp-like. I agree. And when he said his political statement, that's when I really felt it was Karp-like, because Karp doesn't shy away, right? Karp will say anything about politics. He'll call out Germany. Like he doesn't care. But the thing about Palantir is that their business is based on a particular political view, not really Democrat or Republican, but you know what I mean in terms of how they procure contracts. So the CEO kind of has to be political. There's no way he can't be political. I mean, half the business is government revenue. So Noto kind of being political there is kind of him saying, look, I don't give a fuck anymore. We need to get this stock up. And in order to get this stock up, we need to have a certain administration. And that's just how we need to operate. I was just really surprised he said it. I really did not think he would actually end up saying it. Some of you are saying you were turned off by it. The rest of you are saying that at least he ended up saying what he felt. Yeah, he said what he felt. And I think that was the main thing that people were looking for. Okay, so that's what we got in the context of SoFi. Overall, great interview for Noto, and we'll see what happens from there. So that was SoFi. We've got now, besides SoFi, to look at the broader equity market. CPI is tomorrow, folks. CPI, I'll be live at 8:20, is tomorrow. When I say I'm nervous, I am nervous. Okay, I am very nervous. Now, some people thought Bitcoin going up yesterday was kind of a preview to CPI potentially being leaked. Was the argument, because when Bitcoin shot up, the argument was like, okay, CPI came in cold, and now like we definitely are getting a rate cut, and therefore Bitcoin can go higher. Maybe that was the case, maybe not. But the point is, Bank of America, Barclays, JP Morgan, all these guys. Oh, and tomorrow we have the start of earnings. They all believe we're going to come in at 3.1, which would be down from 3.2 month over month. Now, some of them still think 3.2, like Bank of America and Goldman Sachs. Other TD Securities a little bit more bullish. They think 3%. Last time we got 3.2. If we come in at 3.1, 3.0, or 2.9, it's going to be really fun. If we come in at 3.2, I don't think the market tanks. I think the market kind of just, does whatever it does, probably stays flat. If we come in at 3.3, I don't know how easily the Fed is going to be able to say, yeah, we're definitely going to cut going into September. I still think they're going to do a cut because they have to do a cut, but I don't know exactly, how it's going to play out. Now, on the last 8 CPI reports and what the S&P did, on June 12th, it went up 0.86%. May 15th, this is from 2023, it went up 1.18%. April 10th, it went down 1%, but it recovered the next day. March 12th, it went up 1%. February 13th, it went down 1%. January 11th, it was flat. December 12th, it was up 0.47. And November 14th, it was up 1.9%. So basically 1, 2, 3, 4, 5. The last 5 out of the 8 CPIs were positive. The 2 of them were negative, but it recovered within 24 to 48 hours. And then one of them, January 11th, was flat. So, I mean, based on what we've seen in the last 8 CPIs, we should either get a positive day or a negative day that recovers intraday. But as long as we get CPI to come in at 3.1 or below, I mean, I think equities will do okay, and it won't be that bad. So it's going to be interesting to kind of see how it plays out. It feels like the market is pricing in a 3.1 read already. S&P at 557. I mean, if the S&P tries to hit 560, that would be another number that a lot of these analysts raised their targets to. Like they went from 5,200 to 5,600, and we're there. So a lot of them have actually started to race to 58 and 5,900 to give them some more room to get there. But If we get to 56, then it's going to be pretty incredible. The question is, for the rest of the year, do we go up in a straight line, or do we have some bumps in the road before we end higher? And obviously, Q2 earnings is going to be sort of the determinant factor on how that plays out and what happens from there. So let's hear from two different women. We've got to hear from Liz Young first, who is a little bearish, but also bullish in the broader markets. And then we'll hear from Gabriella Santos in terms of what she's thinking. But let's start with Liz. Her argument is maybe you should start taking some profits in large cap tech. And I think she kind of breaks down what we need to see in order for this rally to continue. And then we'll hear from Gabriella after her.
And what it was expecting in July or September. But I think if we get a cooler print on CPI this week, and if we get a cooler print on PPI, September will get priced in as a lock.
Okay. So what does that mean for me preparing for that as an investor? What do I do?
Well, I still think there's a contradiction. It seems like the market continues to cheer cooler data as long as earnings are strong. And that's okay. But as soon as we start cheering cooler data that sometime will catch up with earnings, I think the market's going to have to digest at what point is cool too cool.
Well, that's what Goldman was talking about today, right? I don't know if you saw that blurb from them. The idea that bad news is eventually going to be bad news for the market. Or at least it could be.
Well, and there's been sort of this detachment. We want the economic data to get cooler, but earnings data needs to stay strong.
There you go. We're showing it on the screen right now.
And it continues to be that way. And I think this quarter probably continues to be that way as well. Where we get cooler data in the economy, it confirms that the Fed can start cutting rates in September, and stocks will cheer that. But some of the things that I look at that are a little bit concerning about it is that even if we compare it to the mid-90s and say, okay, the Fed started cutting rates, everything was fine, we secured a soft landing. They started cutting rates at a point when the unemployment rate was 5.6% and falling. So they cut rates at that point into a strengthening labor market. At this point, we just crossed above 4% in unemployment. We've gone up for the last 3 months in a row. It will likely continue to weaken. None of these numbers are concerning, but it will likely continue to weaken. And then the Fed will be cutting into a weakening labor market.
Sure,
the market has to understand.
Yes. Okay.
So Liz's argument here is that right now bad data has been good, right? Unemployment went from 3.4 to 4.1. We saw more more unemployment claims filed last week. So that's good because inflation's coming down, labor's tightening, rates will eventually get cut. Liz's argument is, wait a second, at some point bad news is going to be bad news. And how does the market react? Because eventually bad news is bad news, affects earnings. Here's an example. Unemployment goes up. People stop buying stuff from Facebook ads. That means Facebook makes less money on advertising, right? So boom, that's going to affect Facebook's earnings. Liz's argument is if that happens, eventually there's going to be a contraction. But the question is when that happens.
Okay, but weakening from a high level.
From a tight spot.
So that's what the Fed chair said today, right? Yes, the labor market's cooled, but it's still strong, right? He used the word strong. It's back in balance. Is the labor market. It's not like it's falling apart.
Correct.
It's just slowing.
Right. And his
which
idea
is kind of what they need.
Yes, right now.
In some respects.
In this present moment right now, that is exactly what they need. And being back in balance is referencing more how many jobs are open versus how many people are unemployed in order to fill those jobs. We were way too tight before, driving wage costs up, and we all know that put pressure on earnings and companies. The issue is that if you look over history, the longest history you can find of an unemployment rate, as it starts to rise, it hits escape velocity quickly, and it's difficult to stop that rise. The rises usually happen very fast. So right now, we're still in a good sweet spot between 4 and 4.5%. I would call the sweet spot of the unemployment rate, because 4.5% is still what's considered frictional unemployment, what we can expect even in a healthy economy. So that's okay. What we need to not happen is that the speed picks up. If the speed picks up and we can't get a hold of it while the Fed is cutting rates, then it'll look like they're reacting to something that's getting weaker.
Okay. And that's a good point. I mean, her argument is there's like 4.1 to 4.5 is fine, but if we start getting escape velocity with unemployment, which I don't think is happening now at all, really, given the data we're seeing. But if that does happen, then the Fed's going to be reacting. And if the Fed's reacting, the market has lost all confidence in the Fed, which is why we need this rate cut, which I think Liz also believes we need this rate cut. So it seems like the Fed is being anticipatory versus reactive towards a weakening economy.
So maybe the most debatable idea you have that we can kick back and forth is this idea of a portfolio move to make right now. Trim some gains, particularly in large caps that are driving the market. You're talking about mega caps, okay? And allocate to sectors that benefit from steepening yield curve. We can go through what those are, but
Sure.
You really want to take some profits off the table. I know you're smiling because, I mean, it's like a gutsy call, right?
Yeah.
I mean, some people are going to say, no way.
Yeah.
Why do you want to do it?
So whenever the market gets to extremes, it's at a higher risk of what I'll call normalization. I'm not even going to say mean reversion. I'll say normalization. Some of the metrics that are getting uncomfortably extreme right now are things like the forward PE ratio on the S&P is in the 89th percentile. The spread between the market cap weighted S&P and the equal weighted S&P over 1 year is 17%. That's in the 99th percentile. And then we've got the max drawdown this year so far, only 5%. If we hold that, that's in the 91st percentile. So we are getting to the point of extremes, just in the sense of, okay, is it time for there to be what I would call a redistribution of strength? Okay, that doesn't mean that we have to have this big pullback, but when you get certain pockets of the market that are so overly valued compared to others, there might need to be a redistribution. Some people might call that a broadening.
Okay, well, that's what I'm going with, though, because can you get the broadening do you think there's going to be I'll use your words, a redistribution of strength at the same time where you appear to have some growing concerns about the strength of the economy? So do I want to buy into your broadening story at the same time I buy into your weakening story? How do I do that?
So good question. The broadening story that we've seen so many times has been a broadening into cyclicals, a broadening into small caps. What I would consider a broadening now is a broadening into those sectors that would do well, that tend to do well in a steepening yield curve environment, which is what I expect to happen in the second half if and when the Fed starts cutting rates. We see the 2-year come down. Some of it is financials. As the yield curve steepens, yes, financials should benefit from that. But the ones that tend to do well in a prolonged steepening environment are things like energy, stocks that are paying a good dividend, and then staples, utilities, healthcare. I'll put a little asterisk by healthcare because of the election, but those are the sectors that tend to do well. And that's not even a defensive statement. That's more of a dividend statement, and the ones that are not the high flyers that have benefited from what we've seen in rallies.
Okay. So I think here she's wrong. And the reason I think she's wrong here is because her argument is essentially like, she had a lot of big words there, but she basically says we're going to go from growth to value. I mean, that's your argument. The argument is, hey, growth is way too hot right now. Tesla, Nvidia, all these guys, look at how much money they've got. Look how isolated they are. Look how much they've run throughout the year. All of them up almost, besides Tesla, 20% plus each. So we're going to have a transition into Verizon and into Chevron and into all these other companies. And we're going to cool off because you got to take some profits on big tech and transition that capital. There's a world in which she's right, but I think this is where, if you listen to Liz Young for the past 2 years, you've lost a lot of money. And the reason you've lost a lot of money or missed out on a lot of opportunities because Liz never had a fundamental thesis on these companies. The one issue I've always had with Liz, and I respect her so deeply, is because the problem I've had with her is she's so data-oriented in the macro. Like when you see her tweets, she'll talk about how, well, this line means this, and historically in 1980, this thing happened, and so this thing shouldn't happen. And it's like, all that was bullshit. All of it was bullshit. And the way the economy is operating right now, it has nothing to do with how the yield curve is inverted. We should not have equities doing this well, given where the 10 years. We should definitely not have equities doing this well, given where rates cuts are. But that's where you have to have fundamental analysis around AI. That's where you need to know, well, what the fuck? Why is NVIDIA having so much GPU demand? Like, why are all these startups training all their models? Like, what does that mean for the broader economy? Why is Facebook getting more engagement on their ads? How are they able to do the targeting? Like, all of that stuff, I feel like she never looked into. And when you looked into that stuff, and you saw that Facebook bought 700 or 400,000 GPUs, H100s, at the end of 2023, and no one was really talking about why H100s are so important. But then you saw their ad numbers explode, and you realized, oh, so something's happening in the economy that is macro-oriented, but it's not macroeconomic. It's macro-technological, which is AI. Everything changes. Everything changes. So from that perspective, her argument right here, cut big tech and trim profits. I don't know if I agree with that, dude. The only way she's really right on that is if Q2 sucks. And the broader question is, the reason NVIDIA got upgraded to 150 from two banks and 180 yesterday, NVIDIA right now 133, is, do you think NVIDIA is overvalued here? Basically, what Liz Young is saying is a lot of these tech companies are overvalued, right? Which is why you need to take profits and transition into value. If the inflection from growth to value doesn't happen, which is the recession she's been calling for the past 2 years doesn't happen, if that same thing doesn't happen, then you might be taking profits too early, right? Like, I asked this question on Twitter yesterday. Let me ask this question to the chat. Who thinks it makes sense to sell Tesla right now? Who thinks it makes sense? Now, let's put up a couple of scenarios. Let's say you have an average of 160. You got into Tesla right before Elon got paid. Does it make sense to sell at 260? Let's say you have an average of 225 and you got in during the run-up. Does it make sense to sell at 260? Let's say you're in at $100 or below $100. Does it make sense to sell? I think in all of those scenarios, the only time it makes sense to sell is if you got into the high 200s, 220, 230, and you just wanted a quick buck, and it's like, sure, you made some money. But even then, if the trend is your friend here, and the momentum is on the side of Tesla, and the rotation, she keeps talking about this rotation from growth to value. The rotation, in my opinion, has been from really good growth stocks to stocks that are high quality companies, but that haven't grown, i.e. Apple and Tesla. And I want to say rotation, but Nvidia and Meta, Google, they haven't really given up their gains. So I feel like that money's coming from somewhere else. It's not really coming from the other hyperscalers. But the rotation, the broadening, as she calls it, kind of happened with Tesla and Apple going up. I mean, that real $300 billion were injected into the capital markets, given Tesla's market cap goes up by $3.1 billion for every dollar that it adds. It added $100, $300 billion over the past month. That's good for the economy. That's good for the S&P. Tesla's 1.27% of the S&P. I think that broadening is happening. That broadening is just happening in quality, which means maybe you don't trim quality. And Liz Young might not be correct there. She didn't say sell. She said trim. Yeah, I mean, sure, I get it. But at the end of the day, if you're saying trim, right, you're telling your client. I mean, the thing I don't like about when people say you should trim your gains is like, that is the most basic advice ever. It's like, yes, you should always, like, if you want to take profits, take profits. But that's not the argument here. The argument here is she's making a market call that you should trim, you should take profits, because Tesla's not going to be as juicy as it is right now in the next 6 months, because there's going to be a transition from growth to value. By the way, that happened in 2022. In 2022, we did see growth to value happen. If we don't see that happen in 2025, then it's not going to make sense to trim anything right here. Outside of, yes, you should, taking profits is great for, it's always good to take profits, whatever. But if we're talking about, like, what is the trajectory of where the market's going, if you took profits on the S&P when it was at 460, like Liz Young, I mean, like, you missed out. So I think it's a really interesting perspective here. And again, I don't think she's fully wrong about the labor market thesis and that the Fed having to cut before it gets too high and it reaches a point where unemployment is escaping even the Fed's control. But I don't know if that means trim large cap tech and then go into like Verizon and things of that nature. And maybe she's right about that, but it really depends on Q2 earnings. And I don't think Q2 earnings are necessarily going to disappoint as big as it was, or as much as she thinks it might happen. Okay, so that was Liz. Let's go to someone else that I am very fond of, Gabriella Santos. Let's get her perspective on what's happening with AI, the Fed, etc. She's been bullish all year. It seems like she continues to be bullish. Let's see what she's going to say.
Strategists have to say the best strategy is right now.
So we've been getting asked, I would say, two major types of questions. The first one really centered around where are we in the here and now in the economy? There's this macro ping pong going on all year. And the other one is more related to long-term themes. Is AI overhyped? Are there different ways to play it? Are there different themes going on in the market? In terms of the here and now, we find it very much a good strategy to not get caught up in this shifting narrative, but really to look at a combination of data and see that there's a slowdown happening in the economy, but there isn't a tumbling happening at the moment. It's more of a normalization in the pace of growth, normalization of inflation, and a start to normalization of rates. Mm-hmm. And then in the long term, to pair some of the cyclical risk-on positioning with particularly leaning into areas of long-term conviction. We don't think AI is overhyped. We don't think this is a Cisco moment. It's just that there's an important broadening out that's starting to happen of the winners of that theme. And one of the big ones that we see as an intersection of AI and other themes is healthcare. And we really want to make sure we don't forget other themes as well.
But it sounds like you think it's maybe a little too early. We had a debate to start our program, and it seems to be the debate. Top-heavy market, whether it's going to finally broaden. I don't feel like you suggest you really believe in this broadening, at least now, right? You make the distinction near term, longer term.
So I think sometimes the broadening is interpreted as a rotation, as the early winners losing out at the expense of completely different themes. And I think really what we mean by broadening is more an expansion of the winners at the same time that some of those large cap, mega cap tech continue to do well as well.
That's the difference between her and Liz. Her argument about broadening is expansion in the winners, i.e. Tesla and Apple that were down the majority of the year and then they picked up. Liz's argument is no, all that money is going to go into like traditional value names. And so both of them differ from that perspective. The question is, will Q2 earnings end up supporting big tech broadening versus the transition from growth to value?
Well. And this is where I think it's really important to see that we have started to see some broadening of the AI beneficiary theme. So what's the whole compute going into data centers? There's a whole variety of semiconductors, supply chain providers that can do well. Taiwan is up 33%. That's another way to play the compute power of data centers, as well as the hard infrastructure and energy required. Utilities seeing some love again, for example.
Sure, but I don't hear you making an argument away from the AI conversation. Yes, I mean, you're still talking in large pockets about the growth trade, just different levels of it. Now, I'm not putting utilities into that, obviously, but that's primarily where you see the best opportunities still.
But I think, yes, related to this long-term theme where we have conviction, it's not, cyclically moving up and down. It's very much the early adoption investment phase. But that includes companies that are found in the US and overseas, companies that are found in your traditional tech and in utilities, in industrials. And we're also making a related but separate argument to focus in on what's happening in healthcare. Mm-hmm. This is partly a key beneficiary of AI, and unrelated, it's also the other big disruptive theme that's happening, which is GLP-1 drugs. And that's one where I think is very much underappreciated recently on performance and valuation.
But
So again, the difference here is Gabriella believes AI is not hype. It is very real. These companies are putting up tremendous numbers. And one of the things about Google, Meta, Amazon putting up these numbers is they have so much cash. They have so much cash, and that cash gives them so much flexibility. The reason why it's good that these companies have cash, this one is not as big as Google and Amazon, but still they have the ability to pay cash if they want to acquire a company. AMD just bought Silo AI, the largest private AI lab in Europe. I don't know anything about Silo, but the fact that they paid more than $500 million in cash for Silo AI, you can only do that when you're at the magnitude of an AMD, of an NVIDIA, et cetera, and you have that much cash to give out. And obviously they're buying the largest private AI lab in Europe because they believe for their European expansion needs to grow AMD's business, Silo AI will play a big role. And so it's really hard to keep thinking that the AI cycle is overhyped, which is kind of what Liz Young is implying, is that there's a little bit too much hype here. That's why you should trim some of the mega caps, because if you have like even a 3 to 4 year horizon from here, remember, AI just started in late 2023 when ChatGPT kind of went mainstream. So we're basically 1 year into the AI build out, and we haven't even got to the software application use cases of AI. That's where I think Palantir is going to be a winner. Then if the broadening of that rally, as Gabriella says, happens within those companies and some of the other external companies, that's why I loved when she brought up TSM. Bro, TSM is up 80% this year. TSM is up 80% this year. So her argument here is that it doesn't just need to be the Mag 7. TSM up another 2%. You got $957 billion in market cap. It doesn't need to just be Apple, Google, Meta. It could be beneficiaries of the supply chain ecosystem for semiconductors like TSM, where the rally is going to quote unquote broaden out to. I mean, if you told me TSM would be touching almost $1 trillion in the beginning of the year, I wouldn't have believed that. Chris says late 2022. Yeah, I meant to say late 2022. Really, ChatGPT went mainstream in March of 2023. That's when ChatGPT actually hit 100 million users. So let's call it early 2023. So it's been about 1.5 years now of ChatGPT actually hitting mainstream adoption. We're still early. I would say, and it seems like, Gabriella Santos and a lot of these other tech CEOs believe that we are just in the beginning of building this stuff out. So if the broadening of the rally is not going from Amazon gains into some random value stock that historically would do well when we are, getting to an impending recession, if the broadening is just going to be ASML or Lam Research or some of these other third-party beneficiaries of the broader AI supercycle are going to be the ones that get value, like Vertu, that stock is up incredibly, and I think they're building out energy infrastructure for AI. I mean, it just seems like It just seems like the broadening of this rally is going to happen in a different way. And so you got two perspectives here from Liz and Gabriella. One is that the broadening happens from growth to value. The other one is that growth continues to grow, but other names in the growth sector are going to grow. And I think Q2 earnings is going to determine pretty much how that plays out. And so we'll see. We'll see how that ends up happening. Akshat says AI is not a hype cycle, but the valuations are extremely high. I would agree. Some companies have extremely high valuations, but I wouldn't say all of them. Like, I wouldn't say Amazon is overvalued. At 2.07 trillion, doing 100 billion TTM off AWS, 44 billion TTM off advertising, which is like basically a new business for them that started. Even Bezos selling 2 million shares yesterday is not enough to stop this bad boy from touching $200. Like, people are just gobbling up his shares because they want exposure to Amazon. Now, ARM, I would say I agree. The valuation's stupid there, but that's a unique situation because SoftBank is squeezing it because they own 90% of the shares. So, I mean, let's ask that question to the chat. We got 4 minutes until the market opens. If you believe AI is not hype, but you do believe valuations are extremely high, what company is overvalued to you in the AI space? What company is overvalued to you in the AI space? Yeah, Vertiv. That's the name of the company, not Vertu. Vertiv. That's the name of the company. That is the company that's done. I mean, their stock this year has just been absolutely incredible, and they're a beneficiary in the broader AI super. I mean, even Dell. Who would have thought Dell Computers would have had a resurgence? But Dell has been a bit. I think that is a quote unquote broadening out of the rally as well. Vertiv right here up 103% year to date. I mean, it really is a stock picker's market in terms of finding the stocks that would be a beneficiary of a lot of these companies that did well. That's why my big market call this year has been Robinhood. And the reason for that is because I feel companies doing well helps Robinhood not only with trading revenues, equities revenue, options revenue, but also assets under custody. And so owning Robinhood to me is like, if AMD goes up 40% and I don't own AMD, I don't really care because I know a lot of people on Robinhood own AMD. And so their assets under custody go up. They're going to be trading more AMD. And so that to me is kind of like the way I can play this entire market in terms of what would end up happening. And then there has to be like a fundamental thesis on if Robinhood particularly can deliver and if it can be a valuable player in the broader trading ecosystem. But I think there's a lot of companies that have gone up and they've been justified for going up. I mean, does anyone want to call NVIDIA overvalued here? Right? Like, a lot of people are saying Palantir. Okay, maybe Palantir is a little overvalued. That's fine. But like we broke down yesterday on Daily Palantir. I broke down why I think Palantir is getting a premium, and I talked about a couple of things there. So like, and we've broken down Palantir in depth. But Palantir is expected to grow into their valuation, and then it's up for them on Q2 to deliver that growth. But besides Palantir, like, what company in the AI space is legit overvalued to the point where it's dropping 30-40%? Chris says SMCI and Dell. I don't know, man. I guess we'll see. I think Chris's bear case on SMCI is that they're hardware margins, and that eventually this business does not have as much demand to supply the hardware that the market is thinking it's going to be able to do. But the counterfactual to that is, what if it does? What if the AI data center build out, because SMCI creates the infrastructure for storing GPUs and servers? What if that demand actually does pick up, right? That's the question. Chris says they'll drop 80%. Okay, so there you go. You got a bear call on those. So it's either you believe some of these AI names will drop 80%, or you believe in the next couple years, maybe they don't go up 80%, but they still CAGR at 15 to 20%, which is not bad at all given how well they've done for the majority of the year. And I think Q2 earnings, which starts on Thursday, tomorrow, and then we get real big tech in the next 2 weeks, that is going to be the most consequential earnings this year, because it's going to set up what Q3 looks like, and it's going to really determine if this rally has momentum and if these stocks can maintain their overall valuations. All right, here we go. Wednesday, July 10th, 9:30 a.m. Thank you, everybody, for being here. The stock market is now open. Wake your ass up. We got a green candle on Palantir, 27.52. Again, Palantir holding this 27.50 level, which has been exciting to see. We gapped up as soon as we opened to about 27.67, then came right back down. So let's see how that ends up playing out for Palantir. 27.51. We'll go back to Palantir in a second. NVIDIA up 1.82%. Wow. S&P 500, new all-time high, 557 on the S&P. Wow. 557 on the S&P. Tesla is slightly red or flat, 262. Apple, 229. Apple's gunning for 230. Apple's not stopping. Path is up a little bit. They had layoffs yesterday. Sofi is up about 1% after the Noto interview. We did stream that live. If you go to the beginning of the stream, you can watch Noto on CNBC. Amazon at 199, TSM 187, up 1.77%. TSM is now $25 billion away from $1 trillion company. Nvidia 133, Palantir 2748, ARM is down a little bit, 181. Nike is down again, 72.13. Starbucks down again, 72.64. Alibaba's red, 75.50. Google 190. Enphase 104. Enphase showing some love, up 1.3%. Walgreens up a little bit, $10.81. Boeing 184. IWM, nice to see IWM and the small caps get green. And again, I think the latter half of the year is also going to be a question of, do small caps get the benefit of some of the profits that are coming and some of the money from sort of the money market funds, or does that just go into Tesla, Apple? Does it just keep going into big tech? And I kind of think right now it's going to keep going into big tech. I don't really know what's the bull case to buy IWM outside of its massive undervaluation. And maybe that does end up happening when we get the rate cut, but it seems like quality continues to get momentum. GameStop up about 3%. Chewy up 0.04%. A GameStop insider bought like 5,000 shares yesterday. I think that's why it's up 3% right now, because the GameStop bulls feel that is a good sign of things that are happening. So that's up right now. SolarEdge is up 2.75%. And Novix, wow, $17.35. Look at a Novix, man. Wow, absolutely incredible. Sachin says 80 to 70% drop is possible in some AI names. The only question is from where, which current levels or eventual peak, which is still far higher from here. Yeah, and I would agree with that. I think that analysis, majority of the people agree with as well, that there is absolutely a chance where companies can fall 80% in the AI ecosystem. The question is it from here? You know, is TSM falling 80% from $1 trillion valuation, or is it going to be a $2 trillion valuation and then it falls 30, 40, 50%? Like, how does that ultimately play out? Because there is a world in which one day, you know, we wake up in 2026 and TSM has supplied all the chips that are needed to build out all the data centers and semiconductors. And at one point they just come out in an earnings and they're like, hey, we demand is slowing down. We just don't need to supply as much. And then the market's like, all right, so we're going to take our profits. That probably happens one day. It just doesn't feel like it happens a year after ChatGPT comes out. And ChatGPT is the metaphor for AI becoming mainstream. And so if it's just getting started, maybe this does take a little bit more time. Tesla now goes green. So Tesla got upgraded today by Goldman Sachs to $248. It's really, really funny to see the banks finally come out and start to upgrade these companies, because now, you know, after the company runs, they have no choice. So Goldman Sachs upgrades Tesla to 248 from 175. It's really easy to do that when the stock's at 260. Because now if it falls back to 248, Goldman Sachs is going to be like, yeah, well, that's our price target. But we're probably going to see more upgrades going into earnings. And if we get a really good earnings, maybe we see even more upgrades after earnings. But it's nice to see. I mean, think about that. 175 to 248. Goldman gave them a good, what is that? $60 worth of appreciation, about $180 billion in market cap. They said they're worth a lot more. And off what? Off delivery numbers that are still down 15% year over year. Off energy numbers that are amazing, but like it's not like Tesla's not producing the most energy in the world. It really does feel like Goldman upgraded them because they feel, okay, something's going to happen. FSD, robotaxi, something. But it doesn't seem like there's anything super fundamental that they said. AEHR, you guys saying in the chat, that one is up. I don't know about this company. Air Test Systems. This one is up 26%. Market cap $450 million. Volume 870,000. Yeah, I don't know this one, but this one is up 25% on the day. So that one is green. Good morning, Myra. Good morning, Quarantine Quartet. Thank you for being here. Semis. Yes, someone reminded me yesterday on Twitter that Tesla Semi is something that could still pop up as a surprise. Elon did tweet yesterday that Optimus is going to have a new design this year, which is interesting because remember my thesis yesterday? I was like, well, maybe they're going to announce something with Optimus. Now, mine was a little bit more advanced. Mine was like, well, they're going to announce a $10 billion letter of intent from Walmart to buy Optimus robots. So that's probably not going to happen. But if they had some type of announcement like that, the stock would be, you know, totally revalued because that's real money. Elon did say the new Optimus design, which will be complete later this year, is something special. So maybe in Q3 earnings, they show off the new Optimus and they basically say, hey, it's really getting ready to be deployed in factories. We're already using it in Tesla. And then the street has to start thinking, well, Elon said Optimus is worth 25 trillion. Maybe we have to take it more seriously. And that could be another catalyst for the stock towards the end of the year. Nvidia 133, S&P 556.89. Tesla's now red 261. I did close above 260 for the first time in about 8 months yesterday. SoFi's green 640. Apple, wow, Apple 230. Apple is 230. Look at that. Apple's market cap 3.54 trillion. 1% year-over-year growth, 36 PE. The market believes this new AI phone is going to change everything for Apple. Pretty incredible, man. You got to give it up to Tim Cook. The stock was left for dead in the 160s. The Vision Pro obviously failed, and they wasted a lot of money on that, and maybe it makes a resurgence, but that's not the reason the stock is up right now. It's up because Tim Cook convinced Wall Street that the AI iPhone is going to be legit. It's going to be real. I mean, and when you do think about it, there's no other real consumer application of AI besides ChatGPT, and that's like just like an app on your phone or on your desktop. So I guess the iPhone will be that way that consumers interact with AI. And we'll see. We'll see how many people use it. If more people use it, they're just going to get more upgrades over the next coming years. Amit, what are your thoughts on sector-specific ETFs? I like them. I mean, I really like SMH. I don't have any of it, but we saw this in January. We were looking at this because NVIDIA started running, and the idea was, all right, well, let's just get exposure to NVIDIA through SMH. But SMH kept running as well. I mean, look at this. Through the beginning of the year, this is the semis ETF. It was at $163. It's at $277. This is an ETF, bro. Like, ETFs don't run like this. ETFs are supposed to, like, you know, be balanced, and like this thing is run like it's literally an AI semiconductor stock, but it's just a conglomerate of all of them. So SMH, I think, has been, it's up 60% year to date. It's absolutely incredible, dude. So this has been one of the best. I mean, even Jose, friend of the channel, he says when he DCAs, he doesn't even DCA into SPY. He DCAs into SMH. Now, granted, SMH may be more cyclical than SPY, but over the next 5 years, he believes that SMH is a better ETF than the broader S&P 500. ARK did not sell any Tesla yesterday, which was nice to see. ARK Innovation, this ETF just hasn't done this well. I mean, this thing is still down 9% year to date, which is tough for Kathy. I mean, this ETF in the beginning of the year, we were at 54, and now it's at 46. So on a year where the market has ripped, ARK has really not performed. They did sell a bunch of Ginkgo yesterday. They sold more Zoom, Teladoc. They're kind of getting out of those positions, it seems. And it feels like they're going to just double down on more Tesla or even Palantir, which is like number 10 in the ARK fund. But even Palantir and Tesla, which they do have a decent amount of shares of, that has not been enough to catapult the stock so far, at least into June of this year. DNA is at 30 cents. Yeah, DNA. I wonder, they either got to do a reverse split or they're going to get delisted. So eventually one of these things is going to happen to DNA. And we'll probably see that later. Robinhood, 2272. Robinhood had a really nice breakout yesterday at that 23 range, and then it came down a little bit. Bitcoin came down. But Robinhood seems like it's just coiling up. It's getting ready, and they just need a strong Q2. They get a strong Q2, they're going to have a lot more momentum. So we're going to wait on the Q2 numbers, and that's going to be in August. And I think that's going to be their next kind of core catalyst in terms of what happens. Now, if Bitcoin can gap up by then, that would be nice, but as of now, maybe Bitcoin takes a little bit of breather for a little bit and then eventually comes up. But it's good to see, because if Bitcoin does get back to 70,000, I mean, that really helps Robinhood. But Robinhood is maintaining pretty much 52-week highs while Bitcoin's down 20% over the past month, which is incredible, dude. I mean, it's pretty damn incredible for a stock that was moving on Bitcoin back when it was $9. Now it's kind of detached. It still affects it, but not to the point where, you know, the market's tanking the stock because they feel that it's solely contingent on Bitcoin. So it's nice to see that divergence. And if Bitcoin runs, that still will help Robinhood. PayPal at 59, Nike at 72, Starbucks at 72.81, Google at 190, Enphase at 105. We do have Jay Powell testifying in 20 minutes. So we'll hear from what Jay Powell has to say. And then Palantir right here at 27.60 on the day. Not bad. Not bad on Palantir. Still holding 27.50. NVIDIA, where is NVIDIA? NVIDIA 132. Yeah, did get a red candle right there from 134. But still, the fact that NVIDIA is past the 120s, dude. I mean, even that, absolutely incredible. Where's Intel? Intel 34.64. Even Intel still maintaining above that $30 range. Cool. Mursan says, Marasan, good morning from Romania. Good morning from to Romania. Marasan, how are you? Do people talk a lot about Andrew Tate in Romania? Because honestly, that's what I know about Romania. It's like, you might be annoyed that that's the only thing I know about Romania, but I know that Andrew Tate is from Romania. But that's kind of all I know about Romania. So let me know if people actually mention him a lot in the streets. Here's a video of Karp we put out yesterday, just a little bit of a reminder of his energy in terms of why AIP continues to grow. If we get this type of Karp on Q2 and the numbers back him up, it might be a fun second quarter earnings for Palantir.
And we go across the country and we say, You've installed a lot of things. You obviously see the power of AI. There's a question of what AI is. For some people, it's machine learning. For some people, it's algorithms. To some people, it's how do you actually extract value out of large language models. We will show you our product working in hours, and then you can actually compare it to what you would like to do. And in every other culture in the world, that's still very much driven by ideology of what should work. We have deep experience managing algorithms and now, by extension, large language models because of the work that our product has been used to power in the classified space.
Companies are eating it up.
And companies like it. They like the approach. And we go across the country.
I think Carp's going to have the same energy. And I think that energy is going to be very exciting on Q2. And I think, Carp, it's not like Carp doesn't pay attention to the stock. It's not like, remember when I was at the event and I met him, the stock fell 20% the day, because it was the day after earnings. And he said, by the way, no matter what anyone says, we crushed it yesterday. Basically implying, hey, I know the stock took a nasty dive, but like we fucking crushed. And so he is he's astute. He understands how kind of market sentiment thinks about the stock. If the stock maintains 27.50 and they go into that earnings, I think they're going to have a different type of energy, because basically they're going to be telling the market, look, we're probably not growing as much as you think we're growing to give us this premium. Now, maybe they are. We'll see what happens with the results. But I think it's going to be like, still, we got some big dick energy, and eventually we're going to get that growth. So don't fucking tank our stock, because we're here to stay. And I think if he keeps that energy, it's going to be fun earnings. It's going to be fun earnings. Now, if we get the growth and the energy, and when I mean growth, I mean closer to like 23, 24% year over year in raising that guidance, it's going to be fun, dude. Because if the market's giving us this premium on 21% growth, if we get that to 24, 25, inching closer to 30, which I know it's a lot to ask for, but if we get it in this quarter, the market's going to have fun. It's going to have a lot of fun. Did it have any impact on how you view that strategy? Yeah, I mean, again, my thesis for Palantir, I've talked about this many times. It's just like them providing value is the best thing in the world, because the monetization comes after value. I've talked about it in the context of me being a content creator. Like, the reason I relate to them so deeply in terms of their go-to-market is because when you provide value, people actually want to consume your content, and you build from there. The reason Palantir gets Tampa General to pay $50 million for a 7-year deal is because Tampa General can't imagine working with any other company. Yesterday on Daily Palantir, it was a good episode. At the end of the episode, we talked about industry-leading AI platforms. So Palantir has Skywise, that's an industry operating system in the airline sector. They have Concordance, which is for supply chain healthcare. In the healthcare sector for supply chains, they have the partnership with Hyundai Heavy Industries, which is a shipyard sort of Skywise ecosystem. And now they have Athenia. They made it in 2021, but we got a partnership yesterday for a integrated platform and ecosystem for the semiconductor sector. If they keep building these different industry-oriented operating systems, which is not just software, but it's software built within network effects of different vendors and clients that are all paying Palantir to be integrated into that ecosystem, and they build that for commercial space, they build that for energy. They build that for a variety of the different verticals that they're operating in. This is a story that just shows massive growth to me over the next decade, like massive growth. And that means you have to provide value first before you actually try to monetize that. So I think the approach makes a lot of sense. The boot camps is a manifestation of them showing that approach. But now the question is just like, get to the point. We've got to see the growth kick up. And if it doesn't happen in Q2, I am okay with that. Because if anything, if it creates a dip, then we just buy the dip. And if we know that that's on the cusp, and we'll know that's on the cusp mathematically, we'll see the customer count go up. We'll see the revenue not match the customer count, which means eventually the customer count will be monetized in the next 3 to 4 quarters, which means the revenue will eventually come, and that's where the real growth is going to happen. And once that happens, I think that's where we explode. It's just a question of when that does happen, or if that happens in Q2. S&P 557, Tesla 263, Apple 230. Apple still holding that 230 level path at 12. SoFi 641. If you're just joining, SoFi Anthony Noto, CEO, went on CNBC and he says he wants Trump to win. That is not a misquote. He wants Trump to win. He didn't literally say Trump, but he said he wants the Republican Party to win. So he was very explicit that he wants a Republican administration, and I think he wants that because he thinks there will be more capital market inflows. There will be more rate cuts, which will obviously help SoFi. He kept stressing that it's not his fault the stock is down. It's not the company's fault the stock is down. And the way he kept stressing that is by saying, hey, look at our growth. We've performed. Even though lending is not going up, we've performed. Even though student loans were cut off for 3 years, we've performed. However, J. Powell has not performed. And he's not blaming J. Powell, but his argument is like, look, we need rate cuts, and then eventually SoFi will do better. So if you believe that rate cuts are coming and you believe Noto, then SoFi stock hopefully should benefit from that. Sachin says Palantir is of the industry leading product, which is under the radar, is used by financial control, reporting management, which is a staple of support functions of many large companies. Yeah, and their partnership with CAZ Investments is one of their. That's one a lot of people don't talk about. CAZ Investments. That partnership I thought was really special in terms of what they're doing with CAZ for asset management. And if you think about where Palantir could be applied in the broader, global equity system, they're even working with the New York Stock Exchange. That vertical itself, like the finance vertical, which Palantir really hasn't penetrated that deeply. I mean, they work with a couple banks here and there, but they don't work with the JP Morgans, Goldman Sachs of the world, at least not to my understanding. That ecosystem, if they can get in there, I mean, that's a whole nother sector of growth that they can unlock. And so that's why if you're going to bet on SaaS over the next decade, I just can't see myself betting on Snowflake or Datadog. I don't see them becoming industry leading operating systems that have the potential to have network effects and grow. I mean, companies that have network effects, YouTube, Uber, Facebook, right? These network effects are gigantic. I mean, even Threads, by the way, Threads just hit 175 million monthly active users. That's Zuck's copycat of Twitter. Even that thing is approaching 200 million people because Instagram has so many users and Facebook just shoves Threads in your face and then you download it and then, they get a certain amount of people to convert. The network effects of that are so massive. A business with network effects is worth many, many trillions in the consumer space because you get billions of users. In the enterprise space, you can get to hundreds of billions if you have that many network effects because you can get so many more clients. And I think the company that has the real network effect that is undervalued over the long term probably is Palantir. But we'll see if the growth can match that going into Q2. Okay, let's take a look at Ross Gerber on Tesla. I actually haven't watched this clip, but apparently they talked about Tesla yesterday with Gene. Ross, as we all know, voted against. We shouldn't forget he voted against Elon's compensation package. So every time he's bullish on Tesla, it's just funny to me, dude, that you could vote against that and then be so happy for Tesla. But let's see what he has to say. And he'll be having a little bit of debate here with Deepwater's Gene Munster.
So is this Tesla rally merely a short squeeze or is something else driving the surge? Let's take it to our leadoff panel. With us tonight, Deepwater Asset Management Managing Partner Gene Munster and Gerber Kawasaki President and CEO Ross Gerber. Thank you both for joining Last Call. Gene, let me kick it off with you. What do you think is behind this surge in the stocks?
Well, I think that there's two pieces. The first is what we saw with the delivery numbers. They were down 5% for the June quarter. That's an improvement from down 9%. But I think investors are starting to fill in the blanks that deliveries will be up 8% in September, another 8% in December, double digits in calendar 25, and probably 20% in calendar 26. So I think the first piece to this rally is related to just investors understanding that we're going to see accelerating growth rates. And then you layer on this opportunity that Elon's been talking a lot about with AI, and you outlined some of those. There's another piece that was not mentioned, which is just the fleet opportunity in AI. But you start piecing together, investors can understand that the profitability profile of this company can be much more attractive in the next few years as they roll that out.
But Gene, if you're looking at Tesla's market share here, what we're seeing April through June is that the market share dropped below 50% for the first time. There you're seeing the market share standing at 49.7%, according to Cox Automotive, where last year it had almost 60% market share in the same time frame. What gives?
Well, the market share, in my opinion, is less important. What's important is the growth rates. And ultimately, their market share started at close to 90, 100%. And the expectation over time was it was going to drift lower. The highest traditional car company has about a 15% market share in the US. I think ultimately Tesla can have a 20, 25% market share. So I've expected that number to be drifting down, and I'm more focused on what the growth rates are. And as I mentioned, they should be accelerating in the months and quarters and years to come.
Ross, you've come out previously and we've talked a little bit about your frustration about the board of directors not maintaining more control over the company and having more oversight. We've talked a little bit about the options available in other EVs. What do you think is behind this surge behind Tesla's share price?
Well, there's two things. First, I want to address the idea that Tesla's going to sell a lot more cars over the next 2 years without using levers like advertising and not having any really new vehicles or a refreshed Model Y. So I would push back and first say all the analysts have been wrong with Tesla's numbers over the last 3 years, and they've been substantially lower than what analysts and even what Tesla expected. And I just don't see why sales would accelerate greatly with the current strategy. Now, irrelevant of that, I think the surge, a lot of that has to do is, I think the worst case scenario where Elon Musk would leave the company because his pay package wasn't approved, that kind of got taken off the table. So that was like a positive thing. The delivery numbers were obviously down year over year. So celebrating that, I'm still sort of like, okay, it wasn't as bad as expected. But at the same respect, they were giving away cars for a whole month with ridiculously low financing deals where Tesla lost money on those cars. So what I think the real thing is, a lot of people are short Tesla and they just get caught. And I don't understand why short sellers are so stupid. You just don't short Tesla. Like, how many times have they lost? I mean, just because I'm unhappy with Tesla and I might sell a little bit of my stock has nothing to do with going short one of the most innovative, important companies of our time. So, I just want Tesla to get its act together. But by far, there's so much more that Tesla can do in the future if they really just focus. So it's hard not to be a bull long-term on Tesla, even though at the current moment, it's a little bit confusing.
I'm just going to.
Do you guys agree with that? Do you think that Gerber, okay, so this is a kind of a two-pronged question. Do you think it is disingenuous for someone to be ultra bullish long-term on Tesla, but in the short term, sell a stock at, I don't know what he sold, 170, whatever he sold at in those low 100s or high 100s, and then make an argument that even though he's upset with Tesla, the company, he's upset with Elon and the politics and the Twitter acquisition, all that stuff, but he's still bullish on the broader ecosystem of Tesla. Is it disingenuous to do that, but still sell your Tesla? Because I think this is where people get upset at Ross and Gary. It's like they're so bullish on Tesla when the thing starts running, but when the shit is in the gutter, when it's fucking taking a hit, when the people that like really depend on your expertise as a, I don't know, whatever you want to call them, a resource in the community, all they have are negative words and critiques. I mean, Gary Black literally going on a gloating spree. By the way, he's deleted all those tweets. People can't find the tweets anymore, but literally gloating about why it was so smart to sell Tesla. Ross, every day saying Elon doesn't deserve any of his money, blah, blah, all this shit. I just feel even if it's not super disingenuous and you can make a rational argument for why that's okay, the community does not respect you and does not trust you. And at the end of the day, if Tesla's a retail stock and there's a cult following around it, you want to at least have respect in that cult. You can have disagreements in that cult all the time, right? People have disagreements on how things will play out, what parts of Tesla are more valuable. But to be that abrasive when things are bad, it just makes you no different from a regular analyst that doesn't know what the hell they're doing. Like a lot of these analysts upgrading Tesla today, like where were these upgrades when Tesla was at 140? How could you not see that picture? What are you analyzing if you're not seeing the bigger picture when the stock's in the gutter? The whole point is to analyze and see the future, right? It's easy to see the future when the thing runs up 100% because like, okay, well, now it's easy. Like this is where I give Dan Ives all the credit in the world. He was the only public analyst that I know, him and Kathy, that when the stock was at 140, they were like, yeah, things suck right now, but we still have a 350 price target. We do believe Tesla's the most undervalued AI company, et cetera. The other ones just didn't really maintain that same bullishness. And again, that doesn't mean you have to be a bull to just be a bull. That's not my point. My point is not just be bullish to like make people happy. My point is, if you had a long-term thesis and in the short term it's taking a dump, does that entire long-term bull thesis just like go out the window? Because it shouldn't, right? Like then what was the point of that long-term bull thesis? Sirecat says, you mean acting like a new retail investor? Yes, exactly. That's basically exactly what it's like. Palantir 2766. Where is Tesla? Is Tesla green? Tesla still green, 262. Apple, wow, 231. Holy crap, dude. 231 on Apple. Nvidia, 133.6, trying to get to 134. ARC, 45. Google, 190. It looks like Google wants to eventually break out to 200 if they have a strong earnings. Google's PE, 29. I think their growth is like 15%. Meta's PE, where's Meta? Is Meta green? Meta is green, 530. Meta's PE is at 30. Basically the same as Google. And I think their growth rate is a little bit higher than Google. Carnival Cruise, that's up a little bit, 0.52%. Rivian, wow, Rivian 16. Rivian went from 10 to 16 in the past 3 weeks. And most of this is because of that $5 billion capital injection by Volkswagen. So that was good for Rivian. TNA up a little bit. That's triple leverage on IWM. Netflix got upgraded to I got to show you this upgrade. They got upgraded to $700 the other day, or like 725 or something. I was surprised, dude. I did not know the street was that bullish on Netflix. Netflix is up like 50% year to date. Yeah, so TD Cowen, Netflix 775. Sorry. They raised the price target to 775 from 725. The analyst said, we think Netflix's broad catalog across multiple genres creates a durable advantage over time. Our Q2 consumer survey showed Netflix still takes this top spot in the living room. Near-term catalysts include the second quarter earnings, third quarter outlook, paid sharing initiatives, and Netflix ad-supported tier. Any further pricing increases could also be a catalyst for Netflix. Does anyone own Netflix? This is one I got completely wrong for like 2 years, dude. I completely got this one wrong. I did not think people would end up getting this excited by Netflix. But granted, it was the only streaming service that really ended up being profitable, and that's why Netflix ended up winning. Where's Rocket Lab? Let's take a look at Rocket Lab. Rocket Lab was at $5 yesterday. Oh wow, 511. Nice. So it hit 525, now at 511. Not bad. Palantir 2766, still holding on a bit. Snowflake is down. Let's look at the SaaS names. SaaS is, yeah, look at that. The only green is Oracle. My video will come out today about Oracle and Palantir, so we'll do a deep dive on that because they solidified their partnership yesterday. The TLDR is Oracle has 300,000 customers, and now Foundry and AIP potentially have access to pretty much all of them. GitLab is green, Oracle is green. Another red day for SaaS. Look at this. CrowdStrike, Zscaler, Twilio, Adobe, CRM. Another red day. Palantir survives along with Oracle and GitLab on the day. By the way, there's a new Shyam Sankar interview. It has like 27 views on YouTube. I'll put the link later, but Arnie found it yesterday. Someone sent it to me a couple of days ago, but I forgot they sent it to me. But he did an interview with some podcast, and so that's a new one to break down. Here's a 30-second clip of him describing Palantir's moat.
We built the Operation Warp Speed supply chain in 5 weeks from a complete dead start during a national crisis. But I could only do that in 5 weeks because 2 years earlier in oil and gas production, I had the original R&D stimulus to build this very sophisticated supply chain digital twin modeling infrastructure to optimize hydrocarbon production. So being able to take in these diverse stimulus from 50 different industries plus government means that the government, the whole nation got to benefit from that. And I think there are countless examples. That is the story of commercial software.
So that argument is really special, dude. That argument, if you're a long-term shareholder, his argument is the government work that we do creates the free R&D, research and development, for us to be able to then take that government technology, bring it to the commercial sector, and then utilize it for a variety of different commercial applications, which helps make our product better. It gives us a specific competitive advantage, i.e. a moat that is fundamentally differentiated from other software companies, and then allows us to deliver real value in different enterprises. And so to me, I mean, like, if they keep doing that, and this Project Maven contract they got, how much R&D are they going to get from building out Maven? And then they can take those same tools and bring it to different enterprises. This whole space partnerships they got with Starlab and Voyager, Palantir's been working with their Meta Constellation Geospatial Intelligence product, which has to do with operating in the parameters of space, for the past 8 years. And so I'm assuming that also helped them as they went into the commercial space ecosystem. And it's just really cool in a sales meeting when you can talk to a CEO and say, hey, yeah, we've worked with with NASA on building out geospatial intelligence, so we can probably help you guys with whatever you're working on. That is a really important thing for Palantir, and one of those moats that I don't think necessarily can be ignored. Okay, so Jay Powell's testifying in a little bit. It's going to be starting probably in 3 minutes. We'll have Jay Powell testifying, and so we'll see what he says. Until Jay Powell goes live, which is in like 2 minutes, let's hear from Pomp on Bitcoin and why we need to keep waiting until Bitcoin goes up. As soon as Jay Powell's live, I'll switch to Jay Powell.
Rising on Fed Chair Powell's comment to the Senate Banking Committee yesterday, outlining risks of keeping rates higher for longer. Joining us now, Anthony Pompliano, professional capital management CEO. It's kind of doing what you have always said is possible at any time, and that those are large moves up and down.
Yeah.
Think we're getting down into the 40s, or this is it already?
No, I mean, look, prices go down because there's more sellers than buyers, obviously. And so the question is, who's selling?
Wow, he sounds like me with my analysis on the market open. It might go up, it might go down. If there's more sellers, it goes down. If there's more buyers, it goes down. It's a really incredible analysis, dude. I just make, I gotta spice it up and make it sound like it's very intellectual.
And there's really two main culprits at the moment. The German government has about 50,000 Bitcoin that they seized from a pirating website, and they've been trying to offload it. What's interesting about it, if you look at the on-chain data, is they're basically going to as many exchanges as they can and trying to sell. And so they're about halfway through that right now. It's about $2.5 billion. They've sold about $1.5 billion or so. And then there's also the Mt. Gox Bitcoin that's been distributed. And so I think people more so are scared, hey, if there's billions of dollars being distributed back, are these people who have been illiquid for years just going to sell it? What's really interesting about this is Bitcoin is still very illiquid. And so there's most of the Bitcoin that is out there being held by people that have a long-term view. And so when a seller shows up with just a couple billion of dollars, the price will go down. Now, if I told you someone was going to come sell billions of dollars and the price was only going to go down to $55,000 or so, that's actually pretty bullish, right?
That is a good point. I mean, that's a pretty big sell-off, and the stock, I mean, Bitcoin really hasn't declined that much.
I think that people are looking at this and saying, hey, look, Bitcoin is still pretty healthy.
How illiquid do you think the market is? I mean, we always talk about the whales who have the wallets that have been sitting there forever since the inception of Bitcoin. But how big do you think it is at this point?
At the start of this year, the amount of Bitcoin that had not moved in over a year was over 70%.
70%.
So very high. Now, as the price has risen, some of that has started to get distributed, which is what you would expect in a bull market. And so really the question right now is basically, how strong are those hands, and will they outlast the German government? Will they outlast these, Mt. Gox distributions? And so my expectation is as we get further into the bull market, that number will come back down towards 50, 55%. But still, at least half of the Bitcoin probably is being held by people who have a 10 plus year time horizon.
Didn't it go up because ETFs had to buy and buy the incremental amount that was the same thing that you're talking about now? There wasn't enough to buy to go into the ETF. So then it just slips right around when there is more, but the ETFs are already satiated.
Yeah, I think that there's a huge part of Bitcoin is a free market asset. And so naturally when an ETF gets approved, there's a bunch of people who are very excited. The media is talking about it. People rush in.
But you needed to buy Bitcoin to go into the ETFs, right? And there weren't that many for sale.
Correct. And so about 80% of those flows now, after people have analyzed it, appear to be retail, not actual institutions going in yet. And so I've talked to a lot of folks who run RIAs or large institutions, and it takes a while for them to go through their investment process, underwrite the risks, approve, and then allocate. And so my expectation is kind of the second half of this year, maybe end of Q3, beginning of Q4, we'll start to see a lot more of the institutional flows into those ETFs. And also the basis trade. There was a lot of people who were going long Bitcoin, short the futures. And as that spread has come down, less and less people are saying, hey, I should go put that trade on. And so it's just a very dynamic market with a lot of inputs and, trying to stay on top of it. I still think Bitcoin's got a very good future ahead of it.
So you got Congress, they're trying to do things, right, for clarity. And you've got a Biden-Trump election, theoretically, I don't know, at this point. How does that factor into the regulatory environment for Bitcoin right now? Is it positive or negative?
Donald Trump has positioned himself as a pro-Bitcoin, pro-crypto candidate.
Is he really?
And look, I actually think that if you watch his public comments, he has followed pretty much the exact thought process and journey that most Bitcoiners follow. At first you hear about it, you're like, there's no way this could be real. This is a scam. There's probably criminals using this, et cetera. Then you get interested. Then it's all about price. And then eventually you get convinced of sound money principles and kind of the other ethos around it. Now, what I do see is Democrats are kind of caught in between two things, right? Because on one hand, you don't want to cede the crypto and Bitcoin point to the Republicans, but also you have a number of people in the Democratic faction that are saying, look, we don't like this stuff. We actually want to clamp down on it. And so what you're getting is a bifurcation from what I can see where there's some breaking of, the party lines. And ultimately, I think that people for decades have been voting for their wallet. Bitcoin and crypto is just the latest version of that. And so when they go into that ballot box in November, they're going to look for a pro-crypto or pro-Bitcoin candidate, whether it's at the presidential level or state, Senate, Congress, et cetera.
Will that be enough to be a cat?
All right, we should be getting Jay Powell starting pretty soon. He's loaded up here, and he should be starting in about a minute. Maxine Waters is there. I think she's going to start off with her questioning. And we have some other Congress people that we didn't hear from yesterday. This will probably start off with about 15 minutes of them issuing statements. I don't know if Jay Powell's doing another opening statements because he already did that yesterday. So I don't know if he would do that again. Maybe he does. And then we will get into Q&A. So it should be starting in just a bit. I wonder if there's going to be questions that are different from yesterday. I mean, if they just lecture him about student loans and climate change and, a lot of them have their own constituencies, then Jay Powell's going to just have to sit there and take it. But if they do ask questions, like shelter is the biggest question I think I would want them to focus on, because that's the part of inflation that is most important, I think, in terms of getting it to come down. But I don't know if they're going to care that much about those specific parts. And again, Jay Powell's just going to keep saying he's going to wait for the data. So a lot of this is really not going to, I don't think, have this big of an impact on the markets. Like everything he was going to say, he pretty much said yesterday, it seems like. There he is. There's the guy that we all care about. It's kind of crazy, dude. He's like a rock star, low-key. He's just like, it's like a concert, and he has to be there. And he has to intellectually dance with these senators about whatever crazy questions they have. All right, let me look at some stocks. Palantir still 27.66. Robinhood 22.78. Bitcoin 57.8. Tesla. Where's Tesla?
Committee will come to order.
Tesla's red,
Without
260.
objection, the chair
All right,
is
we're
authorized to
starting.
Declare a recess of the committee at any time. The hearing is titled The Federal Reserve's Semi-Annual Monetary Policy Report. We like creative titles here, and that is our traditional title for Humphrey Hawkins. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. I'll note at the outset this hearing has a hard stop at 1 p.m., which we will strictly observe, which seems only humane. I'll now recognize myself for 4 minutes for an opening statement. Thank you, Chair Powell, for being back with us today. With prices increasing more than 20% since President Biden took office, inflation remains top of mind for American families. In fact, only a quarter of Americans describe current economic conditions as good or excellent, according to the most recent data from Gallup's Economic Confidence Index. Despite President Biden's gaslighting, inflation was not 9% when he took office. It was out of control. The out of control inflation we're experiencing now is something that this administration did not inherit, but is a product of their policies and their overspending. The nearly $2 trillion partisan and fiscally reckless spending as a part of the American Rescue Plan poured fuel on a smoldering inflationary fire. After a delayed response to runaway inflation, the FOMC has acted with a historic pace of interest rate hikes to ease the pain caused by Democrats' failed economic policies. It is a response, not the actual disease, but the response the Fed is trying to tame these flames, but it's a response to Democrat policies here on Capitol Hill in the administration. So far this year, inflation has been more persistent than many, including the Fed, previously expected. There's still work to be done to reach the Fed's 2% target. As I've repeatedly said, the Fed's, as I repeatedly said, the commitment to independence of the Federal Reserve is of utmost importance, and it is critical, especially in a political year like this. Just as Chair Powell, just as you did in previous administrations, you must not allow politics to cloud the Fed's monetary policy. However, despite your best efforts, the Fed independence remains at risk. And unfortunately, calls are coming from inside the building. Under Vice Chair Barr, the Fed's regulatory and supervisory agenda has become politicized. Most notably, the development of the Basel III endgame proposal has been a mess. This process has been cloaked in opaque standards and timelines set at meetings of unaccountable global governance bodies. The Fed has promised to process 410 almost universally negative comments, public comments, regarding the unjustified and underutilized initial proposal, or an underanalyzed initial proposal. Recent press reports, which seem to be the only way Congress gets details on the Basel III endgame progress, and your comments yesterday indicate the Fed will finally conduct a long overdue quantitative impact study. That is welcome. And if true, this is a promising development. Chair Powell, the last time you testified before this committee, you stated that the initial Basel III endgame proposal will undergo, quote, broad and material changes, end quote. Yesterday in the Senate, you said the board supports reissuing the updated proposal for public comment. I'm concerned that press reports also claim the Fed will tuck any changes to the proposal into this quantitative impact study. That study, including the substantial changes to the proposal, would then be issued for public feedback with relatively paltry comment period. I'll reiterate to you here what I've said to you in private. Broad and material changes to the Basel III endgame necessitate a full reproposal, full stop, full stop. Failure to do so will result in an immediate Congressional Review Act vote out of this House of Representatives as quickly as we can possibly process it. Now, it doesn't have to be this way, and I think the Fed adhering to its longstanding principles here is highly important, especially with this interagency process. I'll close with this. Your steady and capable apolitical leadership of the Federal Reserve has shepherded our economy through extreme uncertainty. We now find ourselves in the midst of a new type of uncertainty surrounding the leadership of our nation. Doubts, fears, and panic often lead to bad decision-making and even worse policy. I urge you to reject outside political pressure in this volatile time and stay the course for the good of the American people and our economy as a whole. Thank you for your service, and I yield back. I'll now recognize the ranking member of the full committee, Ms. Waters.
Thank you very much, Mr. Chairman. Welcome back to the Honorable Jerome H. Powell, Chairman, Board of Governors of the Federal Reserve System. Chair Powell, as we saw with the latest jobs report, the labor market remains strong and the economy is surging. Despite inheriting an economy from the prior administration that had the worst jobs record since the Great Depression, President Biden has now overseen a record 15.7 million jobs created since he took office, with 206,000 new jobs created just last month. Not only that, but under the Biden administration, we're witnessing low unemployment rates, rising wages, and stabilizing prices for goods and services. This is not only because of President Biden's strong leadership, but also because of the historic legislation signed into law by President Biden, which has resulted in lower costs, created more jobs, rebuilt our infrastructure, supported small businesses, eliminated mostly junk fees, wiped out more than $144 billion in federal student loan debt for 14 million borrowers, and cut child poverty in half. President Biden is and will continue to advance policies that are providing good paying jobs and an economy that works for everyone. Now, while I'm pleased to see that inflation is declining, the latest data makes clear that housing remains the #1 driver of core inflation. Since 2020, house prices have increased by nearly 50%, with Americans now spending on average over 30% of their income on housing. This is a top priority for Democrats, but remains an afterthought for Republicans. Earlier this Congress, I reintroduced my comprehensive legislation housing package, including the Housing Crisis Response Act. This bill provides more than $150 billion in fair and affordable housing investments, representing the single largest investment in affordable housing in our nation's history. These funds would create nearly 1.4 million affordable and accessible homes, bring down housing costs for all, and revive the American dream of home ownership. Committee Democrats are committed to getting this bill across the finish line and continue to hold out hope that our Republican colleagues will finally join us in this effort. Unfortunately, extreme MAGA Republicans are not just ignoring housing inflation, they're advancing their Project 2025 manifesto that would dismantle U.S. democracy and the economy as we know it today. Project 2025 is authored by almost 24 former Trump White House staffers and Trump administration officials. It was compiled and published by the ultra-far-right Heritage Foundation, whose CEO recently declared that they are, quote, in the process of a second American revolution, which will be bloodless if the left allows it to be, quote unquote. And if that kind of talk reminds anyone of the rhetoric we heard in the lead up to and on January 6, 2020, it should. Project 2025 promotes radical ideas to materially undermine the Federal Reserve, if not effectively abolished. MAGA wants to put you out of a job, Chairman Powell. So I look forward to your testimony and hearing from you, a Republican who was first nominated by President Trump, about your thoughts on the importance of the Federal Reserve and the work you have done to help our economy. And I yield back.
Gentlelady yields back. I note for the records, Jerome Powell was initially nominated by President Obama to the Board of Governors of the Federal Reserve before being nominated by President Trump to chair. So here we are. We'll recognize the chair of the Financial Institutions Subcommittee, Mr. Barr, the Andy Barr variety, for 1 minute.
Thank you, Mr. Chairman. Welcome, Chairman Powell. Runaway inflation and increased interest rates necessary to confront it continue to hammer Americans, and especially those living paycheck to paycheck. Workers and families feel the pain, making everyday purchases at high prices in the grocery aisles and at the pump. They have suffered years of eroding purchasing power in their paychecks under the Biden administration's economic mismanagement. Heightened mortgage rates make it prohibitive for new home buyers to reach the American dream of a starter home for their family. I am pleased that the Fed is resolute in getting inflation under control. I am pleased that you have committed to an apolitical approach to this. I am not pleased by the Fed's opaque, unjustified, politicized, and underanalyzed regulatory proposals, which will ultimately hurt all Americans. We need to know where the Fed is going on its fundamentally flawed Basel III Endgame proposal and its opaque regulatory approach. I yield.
Well, Chair now recognizes the ranking member of the Financial Institutions and Monetary Policy Subcommittee, Mr. Foster, for 1 minute.
Thank you, Chair McHenry and Ranking Member Waters. I'd like to also thank you, Chair Powell, for joining us today and for the role you have played in combating inflation and supporting a stable economic recovery. While the presidency is often the focus of political pronouncements about macroeconomic conditions, there's no question that that undersells the importance and the independence of the work of the Federal Reserve Board. While actions taken by the President and Congress certainly play a significant role, monetary policy decisions made by an independent Federal Reserve are the big dog in shaping macroeconomic conditions that shape economic outcomes for millions of Americans. And work continues on inflation, but significant progress has been made to bring the country in line with the Fed's 2% target. The good news is that macroeconomic policy is working as designed. Well-calibrated monetary policy with fiscal support from the American Rescue Plan, the Infrastructure and Jobs Act, and the CHIPS and Science Act has powered strong job creation and low unemployment while staving off a recession that many thought inevitable, and far better, I should point out, than our peer countries. While Democrats are committed to supporting your efforts to cut costs for American families, I yield back.
We'll now welcome the testimony of Jerome Powell, the 16th chair of the Federal Reserve Board of Governors. Chair Powell, you'll be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, your written statement will be made a part of the record. You're now recognized for 5 minutes.
Chairman McHenry, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Federal Reserve's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We've also seen moderate growth in capital spending and a pickup in residential investment so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still at a low level of 4.1% in June. Payroll job gains averaged 222,000 jobs per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in labor force participation among individuals aged 25 to 54 and a strong pace of immigration. As a result, the jobs to workers gap is well down from its peak and now stands just a bit above its 2019 level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past couple of years, but remains above the committee's longer-run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July, after having tightened the stance of monetary policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. Our restrictive monetary policy stance is helping to bring demand and supply into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy. Congress has entrusted the Fed with the operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment and price stability. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans. I'll conclude by emphasizing that we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Well, thank you, Chair Powell. I'll now recognize myself for 5 minutes. Chair Powell, let's begin with this question of the Basel III endgame. I know you had questions about it yesterday, but I think we need further clarity. Your testimony about Vice Chair Barr's discussions with the FDIC and with the OCC on the next steps for the Basel III endgame. You mentioned potential changes have been made to the original Basel III endgame, that a lot of progress has been made, and that the board is very close to agreeing on the substance of those changes. But the next steps, that's really what I want to get into. Let's get through the mechanics of what happens next. If the Fed the OCC and the FDIC agree on the substance of whatever changes you're going to make, what happens then? Like, walk through the mechanics as you anticipated. Okay.
So we're very close to having exactly that agreement on the substance of the proposed changes pursuant to those talks. The next question then is how to proceed. And, it is my view and the strong view of a number of board members that the appropriate thing to do is to take that new proposal and publish it along with the effects of the quantitative impact survey and put that out for comment again and receive comment on that, and then take some time to review those comments before finalizing the regulation. And that's a discussion we're having with the other two agencies now. We have not been able to reach agreement on a path to do that, but that's something that we think is the right way to do. That's what we've done in similar situations. There aren't that many similar situations, but when we see broad and material changes to an important regulation, we think let's go out again and give all the commenters another chance to comment.
Yeah, and that also avoids serious lawsuit risk and the risk that Congress step in and overturn this rulemaking using the Congressional Review Act. I think the other agencies here, if they're not agreeing with the Fed, they're running against the independence of the Federal Reserve here. This is not a trifling matter of policy. This is a matter of real substance for the independence of the Fed and rulemaking at the Federal Reserve, which I think we should be able to keep the independence of the Fed separate, especially in this political environment. But opening up to a new comment period, so that means you have to get consensus for the Board of Governors on the policy. You have to get the agreement of the scandal-plagued chair of the FDIC or the 5-member board of the FDIC. You have to get agreement by the acting comptroller of the currency. These people should not have real standing with the Fed on a matter of serious policy, especially with a chair of the FDIC that is being ousted by his own party as soon as they can get a replacement confirmed. It's an absurd thing that the Fed has to go to an acting comptroller of the currency and a guy who's going to be out of a job very soon at the FDIC and get agreement. But thank you for listening. That was more of to convey this. So the quantitative impact analysis, is this going to include the interplay with the stress tests, GSIB surcharge, all the other capital charges here? Will that be a part of the quantitative impact analysis?
It'll be this proposal, which does include changes to the GSIB surcharge, but does not include the stress tests.
Okay. But the goal here with the quantitative impact is to actually measure the impact of these rules as enacted, right? Based upon what is existing regulatory structures. Okay.
That's right.
All right. So let's get into the question of balance sheet as quickly as we can. 2.5 years ago, you stated, quote, the committee intends to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves. That's 2.5 years ago. Where are we in this question of what are ample reserves?
Well, so the balance sheet, the runoff in the portfolio is now, I think, $1.7 trillion so far. So we've made quite a lot of progress. We think we have a good ways to go. And as I mentioned, and as you just mentioned, we've now slowed the pace really with a view to getting as far as we can without creating frictions and disruption that might cause us to prematurely stop shrinking. Going a little bit slower might actually enable us to go further. We think we have quite a ways to go. It's very hard to be precise about it. It's really a question of supply and demand. And we'll find that level with a little bit of a buffer on top of it, and that's where we'll stop.
All right. Thank you for your testimony. The ranking member, Ms. Waters, recognized for 5 minutes.
Thank you very much. Chairman Powell, are you familiar with Project 2025?
Oh, boy.
Not really, no.
You've heard about it?
This is very political.
I really don't focus on these things at all.
You don't focus, but you know there's something known as a Project 2025? The reason I'm asking you is because one proposal is to get rid of the Fed's dual mandate to promote only stable prices, but also maximum employment. This is your mandate. These are mandates, right? This is what you do. Is that right?
We do serve a dual mandate. That's right.
And so if there was anything that would get rid of the mandate, what would it do to our economy? What would it do to our country?
So the question of which mandate we serve is very much a question for Congress. My own view has been that the dual mandate has served us well. This is something Congress can change and change back to a single mandate. There are
What do you do to get maximum employment? What do you do?
Well, we have one tool on the economy, and that is we raise and lower interest rates. You'll find, though, that anyway, we certainly at the Fed do believe that the dual mandate has been a good thing, and it's enabled us to. It has not stopped us from controlling inflation when that was the thing that needed to be done.
And so, while of course I understand you may not have seen, heard, or read Project 2025, are you familiar with an effort in the country to get rid of diversity and inclusion?
Oh boy.
I see these things mentioned, but honestly, we're pretty focused on our task, which is maximum employment, price stability. We're strong supporters of diversity at the Fed, as you know.
Are you aware that I created a subcommittee on diversity and employment in this committee?
Yes, I remember that.
And do you think that getting rid of diversity and inclusion interferes with your ability to really realize the mandate of maximum employment?
I spent most of my career in the private sector, and what I observed was really successful institutions in the United States, companies, organizations generally, are those that do a really good job on diversity and get the best out of people and attract a broad, diverse range of talents to the table, and people feel comfortable speaking. So that's the way we feel about it at the Fed, and that's what we've been doing and will continue to do.
And do you think it's important not only to have diversity and inclusion in the public sector, but in the private sector also?
Yes, and as I mentioned, if you look at very successful American companies, you will very often see that they're good at that. They're good at hiring, attracting, investing in, and keeping diverse talent. That's one of the things that our really good U.S. public companies do well.
Have you seen improvement during your tenure where diversity and inclusion has created opportunities for more jobs and have to reduce the unemployment rate?
Certainly seen, I think you see over the course of my long career, a big change in diversity and inclusion. And you see that in the private sector and the public sector, and I think that's generally progress. I do.
Under the work of this committee, and the subcommittee is chaired by Ms. Beatty, she was able to gather important data about what was going on in the private sector. And what she discovered was that many of the CEOs and others welcomed the opportunity to learn more and to do better and to get assistance. And we saw improvement with diversity and inclusion. Have you seen that?
There's no question. If you talk to CEOs, they get this. If you want to attract the best talent in our country now, you need to be committed to these things.
And so I would like to compliment you on the job that you have been doing. I'd like to compliment you on keeping us informed about inflation. Not only do I welcome you here today, I look forward to working with you for years to come. I yield back. Thank you.
Thank you.
The gentleman from Arkansas, the vice chair of the full committee, Mr. Hill, is now recognized for 5 minutes.
Thank the chair. Chair Powell, thanks so much and welcome back to the committee. I want to pick up where Senator Tim Scott and Chair McHenry left off and reiterate my strong support for your comment yesterday in the Senate about the need to repropose the Basel III endgame. The Supreme Court's precedent, I think, makes clear that if a rule undergoes broad and material changes from the proposal to final rule, the public must be given a meaningful opportunity to review and comment on those changes. You generally share that view, I think. Is that right?
Yes.
And I'm looking forward to seeing the results of the quantitative impact study and the separate comment period, as well as an interagency agreement you referenced yesterday. Because of Dodd-Frank's role and the vice chair for supervision, Vice Chairman Barr's role and the Fed's role, would it be fair to say the Fed is a first among equals on proposing a rule like this? In other words, does the Fed have a supremacy position on determining whether it should be fully reproposed or not, or do you view it strictly as a collaborative basis? Just curious in your view on that.
I would say it's strictly collaborative, and I would say that our discussions with the FDIC, which Vice Chair Barr has actually been conducting, and the OCC, they've been very productive so far. So I want to make sure to say that we've continued to work our way through this, and I believe we will get fairly soon to a resolution of the remaining process issue.
Good. Well, let me turn from that subject to the court's recent decision to overturn the so-called Chevron doctrine. Many of us believe this was the first step to reining in decades, literally, of an unprecedented, uncontrolled growth in the administrative state. And so I think all of us on at least this side of the aisle are certainly saying to the Federal Reserve and other federal agencies in our jurisdiction that we want to reassert Article I authority over the direction that independent agencies work. Would it be fair to ask you to certify that because of this change in Chevron that the Fed would commit to promulgating new rules only if they're at the direction of an explicit congressional authorization?
So I think, first of all, we're studying that and several other decisions that have just come down in the last week or two. So I haven't got anything definitive for you on that. I think you know us to be an organization. I know us to be an organization that is strongly committed to the rule of law. Supreme Court says what the law is. We'll always do what we believe the law is.
Well, I'll submit that question maybe in more detail in writing, and maybe you'll have a chance to reflect on that. Back in February, you were on 60 Minutes, and you said the U.S. budget deficit, the national debt are unsustainable. Do you still view that the U.S. is on an unsustainable fiscal path?
I do. I think I tried to be clear that the level of the U.S. debt is not itself unsustainable, but the path that we're on is unsustainable, and I think that is not controversial.
I think many of us certainly agree with that, and we know that when the deficit's at 3 times the economic growth rate and growing, it's of concern, and it's contributed to inflation. Just 3 years ago in Jackson Hole, Wyoming, you gave a speech where you were confident that inflation was transitory, which I think we've come to realize that's not the case. This hearing is sort of a can't-miss opportunity for the Fed to demonstrate some humility on the monetary policy decisions, which some on this side of the aisle particularly think have made inflation worse. Your August 2020 Jackson Hole speech, you said the flexible average inflation targeting framework regarding 2%, that you would let it run above 2%. Was the Fed blinded by the previous 20 years of global change that was deflationary and or you were not alert enough in 2020 to be more cautious about that change in policy?
So we were certainly mindful of a long period of time in which there have been very low interest rates, but also very low inflation, suggesting that the neutral interest rate must have fallen quite substantially. That was the standard view. The thing we didn't see coming was the pandemic. It's not like everything went off the rails. It's like we had this pandemic and it really changed the way the economy is working. We had a big crisis. We did a lot of things. So the concerns that led us to those concerns that we were in a world of very low interest rates all the time.
But now, wouldn't you say we're in a very opposite situation where because of reshoring and tariffs and other policies that are quite inflationary?
I would say this. Those concerns are right now. We have the policy rate in the mid 5s, right? And we see the policy is restrictive, but clearly interest rates, the neutral interest rate must have moved up, at least in the short term. So I think that's the question we'll be asking ourselves in our review, which begins at the end of this year.
We look forward to that.
How much of what we did in that time period is relevant to the new world where rates appear to be higher?
The gentleman from Georgia, Mr. Scott, is recognized for 5 minutes.
Thank you, Chairman, and welcome, Chair Powell. It's great seeing you. Last time I saw you, we had the gracious pleasure of you visiting with me in my office, and we discussed a great variety of things. Thank you for that visit. Now, Chair Powell, this year the Fed tested 31 banks, up from 23 last year. Is that correct?
I believe that's right, yes.
And by estimating losses, revenues, expenses, and capital level under hypothetical stress scenarios, we did that, correct?
Yes.
And all 31 banks remained above their minimum common equity tier 1 capital requirements after observing losses of nearly $685 billion. Is that correct?
Yes, that is correct.
Yeah, I wanted to get those figures out and provide you with, you may have heard this, but I want to share with the nation because your vice chair, Barr, made this statement, and I wanted to put this in the record, his exact quote from this great achievement. He said, "Our goal of our stress test is to help ensure that we have enough capital to absorb losses in a highly stressful scenario. And this test shows that we do." I thought that was a great statement of your record. Now, let me ask you my question. It's simple. Will the 2024 Fed stress test results have an impact on how prudential regulators roll out a new and updated capital proposal?
So the two are really two different things. There's the Basel III capital proposal, and then there's the stress tests. So, and really the Basel III, as I mentioned, we've discussed, we're almost ready to put forward for further comment a revised proposal with material and broad changes to it. The stress tests are a different thing, and of course we realize we have to adapt those over time and be open to changes, and it has evolved significantly over time, but it's really a separate thing from the Basel III endgame.
Give us a little bit more information on the Basel III, because I worked with you with this. Our work goes all the way back to the Obama administration when we responded to that crisis with our banks. And you and I worked that up where we came up with the hardest hit program to help those who were suffering with, those states that were suffering with high unemployment and at the same time high home foreclosures. And we were successful. And we've established that program, and it's still going on and helping many of our states. But you know, I want to also share what is happening around the world as a result of our activities. The European Union is now set to delay key parts of its bank capital rules by more than a year so that their lenders will not be at a disadvantage. Over in Canada, it's important to know that their banking regulators have also delayed for another year, imposing high capital rules on countries' banks at the risk of making them uncompetitive. And the Swiss National Bank is highly unlikely now to adopt a proposed 15% capital requirement for UPS and other Swiss banks. And the Bank of England has issued a near final proposal to increase UK bank capital by 3%. And I think this is all a measure of your great work and that of your vice chair. And I just wanted to let you have a comment on that, please.
Sure. So we're committed to finalizing this proposal. Our banks are going to live with these rules for a long, long time. The main thing is to get it right, and that's what we're doing. What we do in the end will be consistent with the Basel agreement, and it will also be consistent with what other comparable large jurisdictions are doing.
You're doing a great job. Keep up the good work.
We'll recognize the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you very much, Mr. Chairman. Thank you very much, Chairman Powell. And also thank you for continuing to indicate that you will look at the entirety of the economy, the whole economy. Appreciate that. All right, so one of the nation's largest banks recently warned in a memo, and it's also been voiced by smaller banks, that the current pace of regulations such as changes to capital requirements and lowering debit card interchange caps could lead to new fees associated with checking accounts and other increased costs for small businesses. This does come amid expiring tax provisions that are sunsetting as we speak, that are critical for small business, such as the R&D tax credit, interest deductibility, and bonus depreciation. This does raise the question, are you considering how these regulations and tax increases will directly work against your mandate to achieve 2% inflation? Moreover, with the proposed changes to Basel III, it is crucial to ensure that all stakeholders have a voice in this process, which you are stating will occur. And a Basel reproposal and adequate comment period are certainly very welcome. So, Chairman Powell, yesterday in the Senate, you mentioned that the majority view of the board is to repropose Basel III for comment period. Could you clarify if this means the proposal will be reproposed from scratch, and any other specifics you can provide?
Sure. So we haven't reached agreement on this. As I mentioned, we're working through this with our colleagues at the FDIC and the OCC. And I can't tell you exactly what the form would be. The sense of it would be, though, that we're making material changes and that we would want the public to have a chance to look at those changes in the light of the way they play off against the quantitative impact survey, and should have a reasonable time to comment on those. In addition, we're focused on one big area, but there are institutions that have made comments all across the spectrum, and we're reading all of those carefully. And we're not going to republish all of those. Some of those we can just make changes and move forward on. So it's going to be a very labor-intensive, time-consuming process. Writing these things up takes a long time, and we're going to get it right.
Good, that's great. Obviously, Canada recently postponed, as did the EU and UK, for international competition standpoint. It seems to make sense, and so that's appreciated. Chairman, would you agree that excessive spending, increased taxes, limits on domestic energy production, in principle, are a cause for higher costs for business, contributes to inflation, and as well tightens the labor markets, kind of running contrary to your two mandates?
You're asking me a kind of a political question there. I don't want to criticize a platform of economic fiscal policies that are not really ours to decide.
It's more of an economic question, but I appreciate your answer, sir. So when you mentioned recalibrate policy yesterday in the Senate hearing, was part of your thinking taking a more holistic view of economic conditions?
Yes, very much so.
Okay.
Yeah.
Okay. Chairman, is there any data to support the so-called greedflation? This term greedflation somehow has caused inflation. Is there any data to support those comments?
So we look at it that this inflation has been caused by a combination of very strong demand and constrained supply. So it was really a high-speed collision between an economy that was reopening, and by the way, there was inflation all over the world at the same time. So these are some common factors. But at the same time, you had tremendous demand, for example, for automobiles. You had constrained supply because there weren't enough semiconductors. Long story short, but so that to us is what this inflation is all about. So we've observed, the sort of healing of the supply side at the same time. Restrictive monetary policies weighing on demand, and we've seen inflation coming down from those.
So there's no data that supports that gouging of consumers is part of the inflation.
It's been very hard to track a connection with earnings and things.
Secretary Yellen mentioned that she didn't feel that there was grocery price shock and that sort of thing. Groceries and gasoline are the two driving problems for American families and certainly my constituents. Do you believe your policies are helping to alleviate in those two areas?
So a lot of things affect, let's take energy first. You know, the energy prices are generally set at the global level. We do have some effect on that.
Sorry,
but not
Chairman,
that
I've run
much.
out of time. Thank you. I yield back, Mr.
Sorry, we can continue.
Thank you.
The gentleman from Missouri, Mr. Cleaver, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Chairman, for being here. In some ways, I want to follow up or at least respond to the very civil, but I think reason of why we need an independent central bank. And your response was, you know, the question you raised would, if I answered it, it would be along some kind of a political avenue, and you didn't want to drive on that avenue. So I'm also very much concerned about a lot of the discussion. I've been on this committee a while, and so it comes up quite often. When the Federal Reserve was birthed around the turn of the century, I think around 1913, 1918, somewhere like that. Prior to the establishment of the central bank, was our country experiencing a lot of recessions because of you know, no security? People felt no security, particularly the business community, in making big investments because nobody was in control. Just kind of think that what went on just went on. Is that relevant?
Yes, I think the lack of a central bank between 1836 and the founding of the Fed was a period of lots and lots of depressions, and a lot of it had to do with the crop cycle and the banks not being able to handle the very large seasonal swings, and there was no central bank to provide liquidity. So that's really what gave rise to the founding of the Fed in the early part of the last century.
Do you think that it would be that it is dangerous to blend monetary policy and fiscal policy?
To blend them?
Yes.
So we try to keep them very separate, and you know we try not to express views on fiscal policy that's for elected people who have undergone elections and won and make those very difficult decisions. We have a really specific, narrow but important mandate that we do, that you've given us, and we try to stick to that. And we take your policies as given, and then we conduct monetary policy with that.
I don't want to draw you into any kind of a political response, but and I have not read all of this Project 2025 document. I read some of it online a couple of nights ago. But even whether it comes out of a 2025 or a 3089, whatever, one of the things that I'm concerned about, reading this from this document, that the document argues that the Federal Reserve is the inflation problem, and eliminating the Federal Reserve, imposing economic policy on the Fed that does not come from within the Fed. So I'm wondering here, would you agree with any of that I just stated, whether it came from me or Chairman McHenry or anybody else?
So I'll just say, first of all, we're certainly fair game for any criticism people have. I think what we've learned and what we know is that having an independent central bank is really essential. If you want to have high and volatile inflation, then the quickest road to that would be to undermine the independence of the central bank, of the Fed in our case. So I frankly think that view is very widely held. I find up here on Capitol Hill in both political parties.
So eliminating the Federal Reserve is best for promoting economic stability.
Yes.
Thank you. I knew that the ranking member was going to come in and deal with the issue of housing. She always does, and we all appreciate the fact that she's obsessed with it. and I like that obsession. But I'm wondering as we try to figure out how to deal with this issue. Oh my goodness, my time's
Was that a question?
I didn't finish it, but I sure yes. If you knew where I was going, please.
Gentleman's time's expired.
What was
Now
that,
recognize the
dude?
gentleman from New York,
What
Mr.
just
Barberino.
happened?
For
Thank you,
5
Chairman.
minutes.
What is going on,
Chair Powell,
bro?
thank you very much for being here today. Based on some comments you made today and yesterday, it appears you've made quite a bit of progress on changes to the Basel III Endgame proposal, and you're very close to agreeing some of those, the substance of those changes. I know you won't get into specifics. You said that. I just don't know how deep you won't get into them, but I just want to confirm what you said to my colleague, Mr. Musi. There will be, you're not reproposing some things. It's just going to be a partial reproposal.
That's what we're looking at doing, is major things that we've been working on. And there will be additional changes that will be made that won't be reproposed. That's what we're working on, rather than a full wide proposal.
So it's not a complete reproposal, just partial.
Yeah.
Can you get at least into, can you tell me which components you're?
You know, it's not until it's all agreed and ready to go and vetted. I'm reluctant to try to get into too many specifics, just because, you know, when you're doing these things, nothing is agreed until everything's agreed.
No, I understand. I'm not asking for what specifically your changes,
Yeah.
which, if you're willing to say which.
I hope to be able to
components.
come
Okay.
to you with a really clear answer on that soon. I mean, I think we're
understand.
ready to go at the Fed.
So that's my next question. So it's been said several times that you and many of your members of the board are at odds with your counterparts at the FDIC and OCC over how to proceed with putting out a revised proposal for comment. So if the FDIC and the OCC are not yet on board with allowing for a new comment period, who is holding up this consensus? Is it Chair Grunberg? Is it Director Chopra?
I don't want to say that we're at odds. I just want to say we're working through this issue together.
Someone's got to be holding it up.
Well, you know, it's a discussion that we're having, and I think it's been constructive, and I think we'll try to keep it that way.
Can you at least answer whether or not the 5-member FDIC board needs to sign off, or can you just go to the chair?
No, I think it's the board, and of course the comptroller is one person, but I think I mean, the FDIC can speak for themselves, but I do think their board would be the question.
Okay. One final question on timeline question before I move on. You mentioned yesterday that a reasonable prediction would be that Basel would not be finalized until the first quarter of 2025. Under this timeline, would it be safe to say that implementation would then not occur until at least the beginning of 2026?
Again, I can't be that specific. And, you know, that's, someone asked me, does it sound like the first quarter of next year might be? And I said, it might be. I mean, there's a range of times it would take. The thing is, as I mentioned, U.S. banks are going to be living with these rules for many years. The point of it is to get it right, not to do it quickly. You know, we want to get it right, listen to the comments, make sound decisions, and move ahead in a way that is, you know, gives us a sustainable set of rules that we won't have to come back and fix all the mistakes in.
Thank you. I want to move on to another topic, long-term debt. You mentioned yesterday that you would most likely not move forward with other rules until people reach a place of understanding and acceptance of a revised Basel proposal. I hope that's the truth, as banks need to fully understand the implications of a Basel proposal before any action is taken on long-term debt. Finally, Chair Powell, I'd like to emphasize the need for the Fed to conduct a comprehensive, data-driven, and most importantly, transparent assessment of the current liquidity framework. So very quickly, will you commit to conducting a public quantitative impact study and a full notice and comment rulemaking before imposing any new liquidity requirements?
I didn't catch the first part of that. The first part of your ask.
Will you commit to conducting a public quantitative impact study and a full notice and comment rulemaking before imposing any new liquidity?
On the liquidity thing, I'm not exactly sure what we're contemplating there. We certainly contemplate getting a full range of input from the public on that, because some of these are novel ideas, and we understand that.
All right, as the chairman said before, these impact studies are very important because they're to show what impact these rules will have. So I think that is very important that we have that, because we had a mucked up process with Basel 2.0, and I don't think we don't want to repeat that. And I have a little time left. I'm going to yield to my colleague from Pennsylvania, Mr. Music, because I know he had another question. I thank my colleague, Chairman Powell. Just back to what we were talking about, the price instability of groceries and gasoline, where we do have somewhat of an affordability crisis has been termed. So would lowering rates in the near future be a pro-growth initiative, perhaps? Is that something that's being considered that would actually drive investment and give a clearer picture for investment and perhaps help in these two categories and in the end, increase in supply so as we lower those prices?
So, honestly, when we think about our near-term rate moves, we're thinking about a couple things. And the first of which is we want to be more confident about inflation.
My apologies, Chairman, I went over.
Sorry.
Chairman, I yield back. I yield back to my colleague.
The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thank you again for this hearing, and the ranking member, thank you very much. Chairman Powell, thank you very much for being here. We appreciate it. In fact, I was looking at your history when they were saying who nominated you when you got here and all that. In fact, you had public service even prior to that time, right?
That's right.
So I thank you for your long public service to the nation. I think
Thank you.
you've been outstanding. I think
Appreciate
we all respect you deeply here. You're pretty boring here today, to be frank.
Sorry?
Wow.
You're pretty boring here, to be frank.
Thank you.
Wow.
That's a high compliment.
Yes, it is, because sometimes when you're here, there's all sorts of cameras here and they're watching your every step and all. And I think there's a reason for that, right? And that's because the economy is doing all right. Am I wrong about that?
You know, take a look at our economy. We're growing at around 2%, it feels like. Inflation is down to 2.6%. Unemployment's at 4.1. These are good numbers.
Yeah, I mean, I hear the parade of horribles on the other side, how the sky's falling, but I don't see the media here to attest to that. In fact, it's just the opposite. Did you read some of the headlines of the new government in Britain? Some of the headlines? If not, let me read one. It says, "New British government inherits worst economic plight since World War II." And in fact, there's a number of headlines like that saying that England's in trouble. I imagine if you were running their central bank, I bet you there'd be a whole bunch of media here beating you up to find out, what the hell you're doing or what you aren't doing. And I think the reason for that, again, is I think the government here has done a pretty darn good job. One of the things you said you didn't see coming was the pandemic, right? I'm not putting words in your mouth.
Right.
In fact, I was here and I heard the parade of horribles that we were going to have a recession, maybe a depression. In fact, the country was going to fall apart. Did it?
No. We went through a period of high inflation as the other countries did. And that's very challenging.
And in fact, isn't it the case that most of those countries had higher inflation than we did in Europe?
Over time, there were times when their inflation was higher. I think overall it was broadly comparable.
Yeah, in fact, I brought it up a number of times here because there was a whole bunch of those countries that had much higher inflation than we did.
Well, Europe was much harder hit with the energy issues coming out of the Ukraine war than we were.
Sure. I mean, there's a whole bunch of other issues to instability. They had political instability, a whole bunch of other things, obviously. But I mean, it is interesting today that, the parade of horribles that we hear doesn't seem to manifest itself with the media or the attention that you normally get. And that's good. I mean, I think it's a great thing. Now, I do want to ask a couple questions. I do have concerns, Basel III on housing. I think I've made those concerns known to your office, and I won't rehash them. But I do have issues that I want to talk to you about with regard to climate. Obviously, you said you don't read too much of the news. You didn't hear about Project 25. I don't think that's what you meant to say, and I don't want to put words in your mouth. I think when the ranking member asked you if you had heard about it, I think you said no. I think you've probably heard about it, but you haven't read it.
I've seen nothing more than headlines on it. I mean, I've devoted zero.
Yeah, me too. I don't read
energy
that.
into.
Yeah, I don't read that wacky stuff myself either, but I certainly read the headlines. But the reason I ask about the headlines is that you obviously have seen what has happened in Texas. You've seen what has happened with the climate change. And in fact, you've testified, I think, before that you believe in climate change. Is that correct?
Sure.
Yeah. And so what are we doing? You've taken a number of steps, I think, that have been very positive to make sure that we look at the risks of climate change. Could you go over some of those? Because that does concern me. I think that's a change that we also didn't see. Well, I saw it coming. I've been saying it for a long time, but a lot of people didn't believe.
So, if you're looking at financial regulators, you're looking at people who have a very, very limited role in climate, and that is just to look at the institutions that we supervise and make sure that they understand and can manage the risks that they're running. That we are not climate policymakers.
Right. And I'm not asking
It has to
that.
be elected people who do that.
Right, but you have to take a look at the risks. I mean, look at the risks that the insurance companies are taking, and the banks, of course, are financing these homes, and now you can't get insurance on them, so all of a sudden you can't rebuild. I mean, these are risks that the banks are looking
So
at.
we don't regulate insurance companies.
No, right, but you regulate the banks.
Thanks. Yeah.
And these banks have mortgages on those houses, do they not? Many of them.
Well, in many cases, they're not writing mortgages anymore. So that's the result we're getting, is that banks are saying, they see these risks. They do.
My time's up, but thank you again. Appreciate you.
Thank you.
The gentlelady from California, Mrs. Kim, is recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you for being with us today. Gosh, you're under a lot of pressure from all sides to divert from our monetary policy goals. And I commend you for your leadership and staying focused on the core missions of the Fed, which are price stability and maximum employment. So thanks again for your leadership. And you have stated that it is the Fed's strong view that you will have to reopen the Basel III Endgame proposal for comment again. And I really urge FDIC and OCC moving forward with reopening the comment period. Chairman Powell, would broad support mean abandonment of any modified proposal that garners mostly negative public comments in a public comment period for the modified proposal?
Sorry, I didn't follow your question.
Would broad support mean abandonment of any modified proposal that garners mostly negative public comments in a public comment period for the modified proposal?
I mean, broad support empirically would mean, a good solid vote on the Fed board. And I've tried not to be specific about what that means, but it also means broad support among the broader community of commenters on all sides. That's what I meant by broad support. Yeah, that's what I meant by it.
Thank you. And as the Fed looks to enacting several changes to the proposal, I would also urge you not to overlook how the Basel Endgame proposal would disproportionately impact FBOs and regional banks and U.S. domestic jobs because of the way the outside operational risk is, weighted. So can we get your commitment to that?
So let me just say I'm not going to get into specifics. We're well aware of those concerns. We've obviously carefully digested all of the comments we've gotten from all different sectors, and those are concerns that we're well aware of.
Thank you. Let's switch gear to another matter. You have spoken for the need of transparency. Are there any conversations at the Fed to have more transparency and better engagement and consistency with stress tests?
So we have increased transparency in the stress tests over time, and I would say we do. If people want to write articles and make comments that are critical of the stress tests, we're going to read those and we're going to think about that. We're open to improving it. We know that the stress test has to evolve over time if it's to remain relevant, and I think transparency is one of those subjects where we're prepared to listen and think about ideas.
Definitely. I would like to see more stress test regime that is more transparent and adapted, identifying unforeseen risks. So we can achieve that by being more collaborative, I believe. Yes. So I'm also interested to hear from you whether you and your fellow banking regulators have considered the cumulative impact of any new liquidity standards with the Basel III framework and the existing post-crisis liquidity requirements. So what industry engagement has the board staff held with respect to changes to the liquidity framework?
So we haven't actually made any proposals on that yet. We have had significant industry interaction on the proposals, and we will move, I think, at some time this year.
What about the board staff? have they conducted any industry-wide data collection to study the necessity for and the impact of any changes to the existing liquidity framework?
I think we've done a lot of investigation on that front, but I think that this is the beginning of the process, not the end. We haven't published proposals yet. We're working on them, and it's a pretty early stage.
Thank you. Let me quickly talk about the inflation issue. We had a peak inflation rate of 9.1% in June 2022, and a lot has been talked about being a supply side issue and the demand shock from the opening economy. So can you elaborate how the expansion in the money supply and fiscal stimulus played a role in persistent inflation, and why is it so important to get to the 2% inflation rate goal right now?
So the inflation that arose here was a collision between very strong demand as the economy reopened. Remember that there had been fiscal transfers. We had rates very low. Those things were done because we thought we could be looking at a very, very bad economic time. As it turns out, the economy reopened and demand spiked very high. People had saved a lot of money because they couldn't spend. And so there was tremendous demand and there was constrained supply. And what you got was inflation. And you got that everywhere in the world. That's what happened. So what's happened to bring inflation down, we've made quite a lot of progress on inflation. To bring inflation down, the Fed has been working on with restrictive policy on cooling demand. That has been working. And the supply side has been healing. And the negative labor participation shock has essentially reversed, adjusted for. So it's kind of working out as we had expected.
Thank you very much, Chairman.
The gentlewoman from Georgia, Mrs. Williams, is now recognized for 5 minutes.
Thank you, Chairman McHenry, and thank you, Chair Powell, for joining us today. As the president of the Federal Reserve Bank of Atlanta, Raphael Bostic has so rightly pointed out that combating economic inequality is a critical part of the Fed's dual mandate. When everyone in our community doesn't have the opportunity to contribute to their fullest potential, the economy is not firing on all cylinders. Nowhere is this more apparent than in my home city of Atlanta, which has more Black-owned businesses than any other city in the country, but is still among our nation's leaders in the racial wealth gap. I applaud you and your staff at the Federal Reserve for the work that you're doing to make sure that the economy works as well for the hardworking people of Georgia's fighting 5th District as it does for those in the top 1%. This includes helping to make sure that financial services are affordable and accessible to everyone. As the Fed moves forward with the proposed changes to Regulation 2, I know that protecting access to affordable and accessible banking is at the top of your mind. That is why I was concerned when I started receiving outreach about the unintentional effects that Reg 2 proposed rule would have on marginalized communities, including my constituents in Atlanta. Specifically, I heard about the impact that the reduction in interchange fees proposed by this rule could have on bank-owned certified accounts in my district and across the country. The Bank-Owned Initiative is a partnership between financial institutions and trusted community-based organizations to offer low or no-cost bank accounts to unbanked and underbanked individuals. Access and affordability are at the heart of the changes that you're proposing, and I couldn't agree more with those goals. But we have to make sure that programs designed to serve unbanked and underbanked individuals in marginalized communities continue to flourish. In response to these concerns, my colleague across the aisle, Mr. Lukemeyer, and I sent a bipartisan comment letter in March to you highlighting those very concerns and urging that the final rule not negatively impact low and moderate income communities. Chair Powell, how does the Fed take into account how regulations impact constituents who don't have an attorney or an interest group to submit a comment on their behalf?
Well, let me say first, we have heard those concerns that you raised and others have raised about aspects of the proposed rule. And, we very much understand the concerns that are being raised. In terms of people where we don't have comment letters, we try to be thoughtful about the impact of our regulations, but principally we're looking for public comment on things.
Thank you. The FDIC's most recent data shows that the rate of unbanked households is at an all-time low. The Bank-Owned Initiative has certainly played an important role in this progress. Bank-owned certified accounts are available to more than 95% of low and moderate income households across all 50 states. Access to low or no-cost banking services is a door to financial inclusion and wealth generation for marginalized families. As written, Reg 2 could undo some of the enormous progress made in the past several years. Chair Powell, how can regulators work with members of this committee to ensure that future proposed rules do not hinder Americans' access to tools that enhance the Federal Reserve's financial inclusion efforts?
So we're very focused on things like bank on, as you pointed out, and on access to the financial system for marginalized communities. So we wouldn't want to do anything to weigh on that. We were happy to work with you in your office on those issues. But as I mentioned, we're hearing the comments and we're reading them, and we're taking those into account as we think about appropriate changes to the proposal.
So we will definitely follow up on that, because as we're writing these regulations, I want to make sure that we're thinking about the real world impact and what it means to consumers when they're accessing financial institutions. I look forward to working with you to further the Fed's financial inclusion efforts. Like earlier this week, I sent you another bipartisan letter related to the Federal Reserve's April proposal to extend the operating hours of FedWire Fund service to 22 hours per day, 7 days per week, and every day of the year. That was news that I was eager to hear. This may sound like a small technical change, but it can have a big impact on our constituents, especially for those living in marginalized communities who live paycheck to paycheck. Growing up in the booming metropolis of Smith Station, Alabama, probably never heard of it, Chair Powell. But there are limited options for loans and short-term loans. In an area where everyone needs a car to get to work and they have to work to eat, when money is short, any delay in accessing a paycheck or paying a bill can disrupt your entire household. Extending operating hours for FedWire Fund service and National Settlement Service will allow people continual access to their funds outside of what we deem normal operating hours. And I hear the gavel. I'm out of time, but we will be following up for more conversation. Thank you.
Thank you.
The gentleman from Nebraska, Mr. Flood's recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, after a year with very high inflation that battered American paychecks, inflation rates have moderated some. However, inflation continues to linger above the 2% target rate set by the Federal Reserve. In fact, the PCE inflation index has remained above 2% for the last 3 years. The Federal Open Market Committee's statement on longer run goals and monetary policy strategy issued at the beginning of the year stated, and I quote, "The committee seeks to achieve inflation that averages 2% over time and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time," end quote. Chairman Powell, does the commitment to achieve a 2% average over time apply in the other direction as well? Meaning that if inflation remains above 2% for a protracted period, would the committee instead aim for inflation moderately below 2% for some time in order to achieve an inflation average of 2%?
No, it doesn't.
Is it fair to say that you would need to see the PCE index dip below 2% at least once in the coming months in order to contemplate a rate cut?
No, that's not fair to say. We've said that you don't want to wait until inflation gets all the way down to 2%. Because inflation has a certain momentum. You wouldn't wait that long. If you waited that long, you probably waited too long, because inflation will be moving downward and will go well below 2%, which we don't want.
What combination of factors would you need to see in order to support a rate cut this month or in September?
So I'm once again, I'll say I'm not sending any signals on any particular date of any meeting whatsoever on policy. I said that yesterday and I'm saying it again today, but I will answer your question. So what we said is that we want to be more confident. We want to have greater confidence, and that means more good inflation readings. That inflation is moving sustainably down to 2%. Greater confidence that that is the case. But remember, we have a dual mandate too. We're not just an inflation targeting central bank. We also have an employment mandate. So I could also see us cutting, and we've said this, I've said this, if we saw unexpected weakening in the labor market. And we do now see, I'll speak for myself, I now see the risks to the two mandates as much closer to being in balance. I think for a long time we've had to focus heavily on the inflation mandate, but I think now we're getting to the place where the labor market is getting pretty much in balance to where it needs to be.
That's him saying, I think we're going to get a cut soon.
And so we're looking at both sides.
I know that the media and others have continued to talk about the prospect of political interference with the Federal Reserve. With an election coming up, I know you are very aware of the heightened scrutiny awaiting the open market committee meetings in July and September. Can you use this opportunity to speak regarding the Federal Reserve's political independence going into this election?
Sure, I'd be glad to. So, our political independence is critical to our ability to do our jobs and to sustain the faith of people across the political spectrum. And it comes down to, we make our decisions based on economic data, the evolving outlook, balance of risks, and we don't take into consideration any other factors, including political factors. We have a long history of doing that, and I think the public believes we will do that. Any decision that we make to, on rates, on any of our policy tools, it's going to be very well grounded in the data, and it will represent our best thinking about what is best for the American public in the near and medium term. And that's the promise that I will give and that all my colleagues will give. And that means that we're not looking at things like election cycles. We're not looking at any of those things. We're looking at the data. What does it tell us is the right thing to do? When we figure that out, when we think it's time to move, we go ahead and move, but not until then.
Appreciate that. Finally, I'd like to raise concerns with housing costs. While shelter is one component of the broader PCE calculation, housing often makes up one of the largest, if not the largest, expense for many consumers. Inflation for housing remains persistently high. One of the characteristics of this economy is that consumer sentiment is remarkably low. Do you think high housing costs could be contributing to the persistently low consumer sentiment?
I think high prices generally, I think nobody really can be super highly confident of their answer on this, but I do think it's the fact that while inflation has come down, prices are high, if you know what I mean, and people are paying more for things, more for housing, more for the essentials of life, food, energy, and that to me is how I would explain surveys. We say that the economy is growing, inflation's come down, unemployment's low, and all that's true, but prices are high.
Thank you, Chairman Powell, for your answer and your testimony, and I yield back.
Gentleman from New York, Mr. Torres, is recognized for 5 minutes.
Thank you. Chair Powell, the Fed has an inflation rate target of 2%. Are you waiting for both PCE inflation and CPI inflation to fall to 2%, or only one of those metrics?
So we look at different measures, but for a quarter of a century, the PCE inflation has been the Fed's goal. We've defined our goal in terms of that because we think it's the better measure of the costs and inflation that the public actually faces.
And you've said that you're willing to cut interest rates before reaching the 2% target. Is the decision to cut interest rates going to be driven by reaching a particular target en route to 2%, or is it driven by the overall trajectory of the inflation rate?
It's going to be driven by the totality of the data. There isn't a particular number that we have in mind that we have to get to. It's more, you look at all of the data, and the question we're asking ourselves is, are we sufficiently confident that inflation really is moving down toward 2%? So what's the underlying inflation rate, looking through the volatility? We're also looking, though, as I mentioned, at the labor market, and we're asking ourselves, we have to take into account now maximum employment, that mandate. So we're looking at both of those in the decisions that we make.
I mean, are you confident that the inflation rate is on a downward trajectory?
I do have some confidence of that. I think we've seen that over the past several years. The question is, are we sufficiently confident that it is moving sustainably down to 2%? And I'm not prepared to say that yet.
Chair Powell, you announced a reproposal of Basel III rather than a mere revision. Do you believe that the U.S. banking system is sufficiently capitalized in the absence of Basel III?
I've long been of the view that U.S. banks are well capitalized, and at the level of capital in the U.S. banking system is about right.
Okay. So if the banking system is sufficiently capitalized in the absence of Basel III, then what exactly is the need for Basel III?
First of all, there's no precise answer as to the appropriate level of capital. I think we've been part of developing the Basel standards. They create international broad parity. It's important that we have that. It's important that we do something that is comparable to what the other large jurisdictions are doing, and that it's consistent with Basel. And I think that's what our banks want. That's what we want, and that will be best serving the public.
But you agree we should conform without gold plating?
You know, some things we've gold plated and some things we haven't. And but I think we should I think our end game proposal should be at the end should be consistent with the requirements of Basel and consistent with what the other large jurisdictions are doing.
Are you confident that there's no legal conflict between the standardization recommended by Basel III and the regulatory tailoring mandated by Congress?
I think we can work through all that. Yeah.
Okay. But if there were a conflict,
Basel doesn't impose any requirements on anyone. There's no enforceable requirements. Every jurisdiction does what it's going to do. Basel doesn't bind anybody.
right, but the regulatory framework you're adopting would codify those recommendations,
Yes.
which would have the force of law, right?
Yes, that's right.
And so if there were a conflict between the codified recommendations and an act of Congress, would you agree that an act of Congress would supersede those
Yes.
recommendations?
Sure.
Does the loss of Chevron deference have any implications for Basel III?
You know, it's very early days to assess. There's several decisions that are about administrative law, and I think it's too early for us to say. I mean, ultimately, the question is, are the actions we're taking in compliance with the law? And that decision says that there will be a less deference or no deference maybe to the opinions of the agency, but that just means a court will be answering the same question, which is, are those actions consistent with the law?
The Fed has a target rate when it comes to inflation. Does the Fed have a target when it comes to quantitative tightening, like when it comes to what should be the size of the Fed's balance sheet?
Well, we don't have a specific target, no.
Well, what would you consider to be a healthy size for the Fed's balance sheet?
We define it, not with numbers, but with words. And we want an ample reserves regime with a buffer, so that reserves are not scarce. And we think plentiful reserves, ample reserves is the right place to be. And, we'll find that empirically.
Can you put a number on that?
No, I can't really.
For 4 decades, we've had the best of both worlds, low unemployment and low inflation. Can the U.S. economy return to the golden age of low unemployment and low inflation, or are we doomed to live with a new normal of higher interest rates?
Well, I think we have low inflation. We've got a period here of very low unemployment.
We have high inflation, so can we have the best of both worlds?
We certainly can, and that's the plan.
Okay.
We're going to return to 2% inflation. I'm reasonably confident. Some people argue that we're entering into a world of a lot of upward inflation shocks. That would be a challenging world, but that remains to be seen.
Thank you.
Gentleman from Iowa, Mr. Nunn, is recognized for 5 minutes.
Thank you, Mr. Chair. And thank you, Chairman Powell, for being with us today. Your office has done a very diligent job in working with this body on both sides of the aisle. I chalk some of that up to the fact that you've got some very good folks from Iowa on your staff there, helping keep the trains running on time. So that's excellent. I will note that, in Iowa, the average family has experienced, annual inflation of about $925 per month just in the last 3 years. I've got 6 kids. We're the #1 egg producing state in the country, but yet eggs for each one of my kids goes up 40% this past year, and take that times 6. I'm no economist, but that adds up real quick. And I think I'm reflective of a lot of families across the country right now. So, Mr. Chair, one of the things I'd like to talk about is, what we are focused on and what your department's working on at the Fed. The U.S. Federal Reserve, in my opinion, should be more focused on folks like my hometown of Bondurant, Iowa, versus what's coming out of unelected bureaucrats in Brussels, Belgium, for example, which is one of the reasons I'm so grateful that you have talked about reopening Basel III for a conversation on what's in the best interest of the American people. I applaud you and your team for this. While I would like to see Basel III candidly scrapped altogether, I think that there are 3 things in this proposal that we've got to look at immediately. 1, the impact of credit availability, especially to ensure that it won't be tighter credit conditions on small businesses back home in places like Iowa. The ability for farmers across the country to be able to hedge their grain, corn, soybean, livestock in a new Basel III conversation, and ultimately eliminate the downstream effects on American banks being held to higher standards and very clear in Basel III than what's being held in Europe. So with that, I want to readdress your team's attention to the letter I sent in a bipartisan way with Senator Jerry Moran, specifically emphasizing the negative impact of increased bank capital requirements on the economy, our constituents, and ultimately our ag producers across the country. So What I'll first say is, can you confirm that the next Basel III proposal as outlined will address concerns from our ag growers, including our farmers?
Let me just say that we're well aware of the concerns you're raising about hedging, and I'm not going to be too specific about things, but we're quite aware of those concerns.
I certainly hope your team gets the opportunity to hear that, because it's one of the most painful things I'm hearing back in my home district. Would you agree that the end users' concerns could have been mitigated maybe at the front end of this if, Congress or say a farmer in my district had been included in those opening conversations?
In hindsight, perhaps that's right. But in any case, this is what the comment period is for.
Well, I'll note that 84% of the comments coming from this proposal concern entities outside of banks, as you know. A lot of those were from the ag industry who felt that they had no voice in this and were a recipient of things that really harm their businesses. With that, I want to read quickly, former Treasury Secretary Larry Summers was asked about Basel, and he said, quote, "We're going to need to prepare for consolidation in banking in the future, quite possibly some even further evolution of lending away from banks." Now, I'm going to note here that Iowa has over 250 community banks with assets under $7 billion. His commitment or his comments are of great concern on this consolidation. Do you share concerns about a consolidation amongst banks across America?
So, I speak for myself. I realize that community banks are tremendously important in their communities. And it's not a better world when community banks go out of business or at the same time, if there needs to be consolidation, I don't think we should be standing in the way of that, but we don't want to be part of the reason why community banks are going out of business or being forced to merge because of, for example, high fixed costs because of regulation or other things.
I would agree with you, Mr. Chairman. We don't want to be the instigator for a small bank to have to go out and stop serving a local community. As we look at Basel III, if it's finalized in early 2025, does that mean we will push implementation back to 2026?
I don't know exactly what it would be, but that's something like that is right. We'd have a typical phase-in process at the end of the, quite a lot of work to do to get to a final rule, and then there'll be a phase-in process. I don't know exactly what the date would be.
Thank you, Mr. Chairman. I just want to know kind of a timeline for my folks. I mean, there's obviously 2026, or take my advice, scrap it all together and we can start over if we even need to do that. Let me ask very quickly, with Chevron overturn, is there anything the Fed is doing to identify areas where maybe we have over-regulated at the federal side and you're self-policing right now?
Under the Chevron decision? I mean, again, our view is we're very focused on obeying the law and reading the actual words of the law and interpreting it according to the words that are in the law. This is the way we approach things, and I'm not sure how much will change. Basically, a court will be doing that with a little bit less deference to the agency, but we think we're already interpreting the law pretty carefully. So, and again, these are brand new decisions. There are several of them, and it's way early. We're just studying them now.
Thank you, Chairman Powell. Thank you, Chair, and I hope you continue to self-police. It's much appreciated to you and your
We'll
team.
now recognize the gentleman from North Carolina, my friend, Mr. Nickel, for 5 minutes.
Thank you so much, Mr. Chairman. Welcome back, Chair Powell. I represent a Republican-leaning, very purple district, so my constituents sent me here to get things done. It's been disappointing that we're on track for what I believe could be the least productive Congress in our nation's history. But this committee has done some good bipartisan work on the digital assets market structure bill and stablecoins. It's a place where I have hope that we're going to see some action in this Congress. I know you and I have privately spoken about stablecoins, and here in the House, in a bipartisan way, we've been working diligently to pass a bill to regulate payment stablecoins. This committee voted in favor of the legislation in a bipartisan way last year, and there have been numerous calls from this committee to you and to the Fed asking that you prioritize working with Congress to help push this legislation forward. We've enjoyed our conversations with staff as well. Can you commit to directing your staff to finalize and support passage of stablecoin legislation this year?
So we've been, really pleased to take part in this process, and very much appreciate being included in it, and we'll stay with it. We think it's really important that we have a federal framework for stable coins, and again, we'll be all in on working with you to get that done.
Thank you very much. Big issue for the folks that I represent, housing. Housing, the rising cost of housing hits my constituents especially hard in North Carolina. Our ranking member, Maxine Waters, has made this a big priority for the work that we do in the committee. In North Carolina, we've got 343,000 households that spend over half of their monthly income on rent, leaving little money for other expenses like healthcare, transportation, and food. Access to safe and affordable housing is essential to the well-being of working families and individuals in North Carolina and around the country. Chair Powell, despite the strong economic trends you mentioned in your testimony, housing prices and median rents have increased by nearly 50 and 41% respectively since May of 2020, and they continue to rise. In fact, housing costs continue to outpace modest wage gains. High interest rates continue to add to those costs. For example, high interest rates make it more expensive for home builders to finance new housing. High interest rates also cause landlords to change higher rents and lead to higher mortgage costs for would-be home buyers. I know that you and your colleagues at the Fed are correctly focused on bringing down inflation, important goal, but have you considered that at this point, with housing cost increases being the primary driver of inflation, keeping interest rates high only towards that stated goal?
So a couple things are happening with housing. There, before the pandemic, there was pretty serious housing shortage, and we can't do anything about that. Then the pandemic comes along, and we really think the best thing, the most important thing we can do for the housing market in the medium and longer term is to get inflation under control, so that interest rates can come down, so that we can get back to a more normal interest rate. No one knows exactly where interest rates will go, but they'll be lower than they are now. And the housing market, supply and demand will work their way out, and you'll have supply of housing. There's still going to be a housing shortage at the end of that, though. And it's true that our policies work through interest-sensitive spending. Housing is maybe the most interest-sensitive form of spending, buying houses with a mortgage. We know that we have really significant effects in that market, and it's tough on people, but this is the path to getting inflation down, which will bear fruit for many, many years.
Thanks so much. I don't think I'm going to be able to get in my next question in the limited time I have, but I wanted to give you this opportunity if you'd like it. I've talked to you privately about this and have a pretty good idea what you'll say. But if you would like to say that the economy is heading for a soft landing, you're welcome to say soft landing as much as you'd like right now.
I'll say, for some time, I've thought there is a path to getting back to full price stability while keeping the unemployment rate low. There is that path. We've been on it. We're very, very focused on staying on that path. I would say we're at a place now where the risks to the two mandates are much more in balance than they were.
Wow.
And that means it's not just about getting inflation down. The job is not done on inflation. We have more work to do there, but at the same time, we need to be mindful of where the labor market is. And we have seen considerable softening in the labor market. We still have a strong labor market with low unemployment, by all means. So this is what we are very focused on continuing to work toward.
Thank you very much. And
Thank you.
This is dovish. That was pretty dovish.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being here today. I appreciate that. I represent a working class in South Texas. In fact, my district is mostly Hispanic, one of the most Hispanic districts in the entire nation, over 80%. And my district is also a rural community. So the topic today greatly affects my constituents and is something personal for me. That being said, the population that I represent is a population that the Federal Reserve research has shown disproportionately will be the hardest hit in inflation. That being said, higher prices due to Biden's induced inflation is something not only the nation is feeling, but my constituents are feeling. They're feeling it at the grocery store. They're feeling it at the gas pump. Small businesses are feeling this. And We know that cutting back on their spending, people who are living paycheck to paycheck, they still can't get away from these increasing costs at the grocery store or the gas station. So even small changes have a big impact in rural communities like mine. In fact, the Farm Bureau recently said that the cost of the 4th of July prices, the 4th of July celebration had high increases. The headline reads, record high 4th of July cookout costs, inflation hits the backyard. This report says that costs were up 5% from last year and up 30% from just a few years ago, all during the Biden administration time. Now, the Biden administration wants us to simply forget about the last 3 years and the pain it has caused families in my district. They don't understand why people are unhappy about their current economic situation. And quite frankly, it is angering and it's simply out of touch with the everyday American. It seems obvious that until we grapple with the runaway government spending, that unfortunately we are going to continue to have runaway inflation. Chairman Powell, can you explain to us how the excessive government spending not only increases the national debt, but also affects inflation as well?
Sure. So let me say, first of all, we completely understand that inflation hurts people, low and moderate income people directly and immediately in a way that it doesn't affect even middle class people, because paying more for the necessities of life when you don't have much of a financial safety net, the pain starts right away. We get that. And so it is for those people, among others, that we are doing everything we can to get inflation under control and stay at the job until it's done. In terms of the causes of inflation, the inflation that we're having is not that different from what other advanced economies around the world are having. And it really results from the pandemic comes along. Inflation is low. The pandemic comes along. We shut down the economy. They're sent checks to replace their income. They can't spend that money because they can't go to the movie theater or to a football game because everything is closed. So savings go up. And so people are spending a lot. Meanwhile,
Chair Powell, I have only a minute left, so I yield my time back. I want to shift gears real quickly. I continue to believe that the federal banking agencies, including the Fed, should scrap the flawed Basel III endgame proposal and start over. At this point, the last thing a first-time home buyer, a small business owner, and constituents, as you said, low-income people who are rural people, for example, in my community, the last thing they need is harder access to capital, which is exactly what that proposal does. The public knows it and doesn't want it either, with a whopping 97% of public comments being negative for this proposal. Chair Powell, don't you agree that with the overwhelming negative reception of this proposal, that it shows a lack of public support?
I do think that's fair to say.
Thank you. I yield back.
Bro, what
The
is
gentlewoman
that?
from Colorado, Ms. Pedersen, is now recognized.
He's literally just like, sure, whatever you want to hear.
Thank you for your service in such difficult times. We sign up to serve and we don't know what's going to come our way. And when I think about what we've been through as a country with the global pandemic, the economy in collapse, and what this Congress was able to do to infuse money to keep our small businesses afloat, critical services available, and making sure that we were in a position for the quickest, strongest recovery in the world. And while we have a lot to feel proud of, we recognize and have had many conversations throughout this committee about the pain points that people are continuing to feel with rising costs. And you touched on this. I really appreciate the discussion around housing in an earlier question, because this is the greatest inflationary costs, especially in Colorado, where we have seen significant home price increases, a lack of supply. People are unable to move because They would go to a much higher interest rate, and then people are unable to buy because they can't afford those mortgage payments. And so while you've talked about recognizing that lowering the interest rates will actually help with addressing the housing crisis, we still have a lack of housing supply. So can you talk a little bit more about what's happening, and that, you know, the lower interest rates are only a piece of this?
It's a longer term thing, and a lot of it is it's harder to get lots and zoning and materials and workers, and in many metropolitan areas, the near in areas are all built up. If you look around Washington, I grew up near Washington D.C., and you know, it was countryside just a couple of miles outside the Beltway. There was no Beltway when I was born, but ultimately it's just we have not enough housing, and that was true before the pandemic, and certainly the pandemic did slow down housing construction. I think we'll get back to a more normal economy with lower interest rates and those sorts of things, but we're still going to have housing shortage.
Absolutely. When I think about the other pieces of the fallout from the global pandemic and the changes that we saw in our economy was in commercial real estate. And I've continued to read about regional bank failures and the risks that the commercial real estate poses in the long term for those assets being on the books for our banks. What is your insight on the risk that it poses for our financial stability, and what we should be thinking about here in Congress?
So the commercial real estate situation, which is, you know, it's significantly downtown office and related retail and things like that. This is something the banks have been working their way through for the last couple of years. I think it'll take more time, more years to work all the way through it. We know from the stress tests and from our own work that the large banks, they're going to be okay here. Some of the regional banks and smaller banks have what you would expect, which is high concentrations in their local community of real estate. We are aware of those. The banks are aware of it. I think the supervisors have been around those banks, making sure they have capital, they have liquidity, they have a reasonably, you know, not too optimistic assessment of how much capital they'll need, how big the losses will be. So I think we'll be working through this, and it doesn't seem to be a systemic problem or one that threatens broader financial stability. It does threaten bank profitability and those sorts of things, but it'll be with us a while. We'll just keep working our way through it.
And the ability to continue to loan to small businesses because you're being locked up. You are not going to have enough time to answer this question, but my remaining outstanding question is around the recent Chevron ruling, and how you anticipate that impacting the Fed's ability to adjust to the needs of the country and ensure financial stability without being sued at every turn.
We're just looking at all these new decisions. So in its earliest day, I speak under the control of my general counsel. I don't want to cause him to strike me.
That's how I feel about my staff. I mean, not striking me.
No, but I mean, look, ultimately, we're already very careful at the Fed about keeping within the law. We're really committed to that value, and this ruling doesn't change that. But I think we'll continue to be an institution that's strongly committed to the rule of law.
Great, thank you so much. I yield back.
Thank you.
Gentlelady yields. The gentleman from Wisconsin, Mr. Fitzgerald, is recognized.
Chairman, thanks for being here. There has been a lot of talk about Basel III. Wanted to just change that subject a little bit. Long-term debt proposal, I think should be rewritten and reproposed as well. But at the very least, the rule needs to be tailored as law requires so that regional banks aren't treated more harshly than the largest banks, of course. In particular, the requirement for regional banks to hold long-term debt at both the holding company and insured depository institution, that seems to be a burden is what we're hearing, I think. I just wanted to mention that I would hope that there would be some flexibility for smaller regional banks to pre-position resources because they're obviously, there's some resources that are loss absorbing, I guess is the way you would consider them in the reproposal. Do you have any thoughts on kind of how this is playing out right now or what this looks like?
Yeah, so on the long-term debt thing, we put it out for comment. We've received quite a few comments, and staff has been analyzing them, and that's something we're well aware of the concerns that have been raised, and we're thinking carefully about how to move forward on that. The other one was pre-positioning. That's more along the lines of the discount window and the liquidity requirements, I take it. So
Right.
So we haven't made a proposal there yet. We're thinking carefully about that. I think we're trying to learn the right lessons from what happened last spring at Silicon Valley Bank and a couple other banks. And one of them just is the discount window worked, but we could certainly modernize it, make it more effective. And also we learned, that bank runs are moving just a whole lot faster, at least in that case. And that even bank runs from 10 or 15 years ago were nothing like as fast as what happened in Silicon Valley. So we need to bake that new learning into the liquidity requirements in some way or other. We, again, haven't made a proposal. When we do, of course, it'll go out for comment, and we'll very much want to learn from those comments.
Very good. There's been a clear trend of banks stepping away from the mortgage market, kind of in the face of the increased regulation. That's my interpretation, at least. Non-bank lenders have stepped in to kind of fill that void. Today, banks support the non-bank lenders and the broader housing finance system through the so-called the warehouse lending for home mortgages. But I'm deeply concerned that some of the, as was mentioned by my colleagues earlier, that some of the Basel rules could harm both bank and non-bank lenders alike, kind of undermining the liquidity and kind of the raising costs of home buyers. So let me just ask, in regards to Basel III, the endgame proposal, could it make housing finance less stable, I guess, is the question.
That's certainly not the intention. And we're again, well aware of the concerns that have been raised, and certainly paying careful attention to those.
Despite the smaller issuer exemption for debit interchange fee cap, insurers with less than 10 billion of assets reportedly lost about 35% of inflation adjusted interchange revenue. Have you considered the impact of further reduction of debt interchange will have on small financial institutions with less than 10 billion of assets?
Yes, so that's another one where we put out a proposal. We got a lot of comments, and we're carefully reviewing those, and you're certainly aware of the specific concern that you raised.
As you may know, the latest Fed Y14 proposal, which is used to help collect data for Fed stress tests, asked banks for more detailed data on bank lending to non-banks. As a result, there's concern that the Fed may start trying to indirectly regulate non-banks and the financial risk. I just talked to one this morning that's concerned about that. So given those concerns raised about the lack of transparency in its stress testing models and the potential unintended consequences, is the Fed planning to indirectly regulate non-bank financial institutions through these tests?
That's not the idea. The idea is we see intermediation growing very quickly in non-banks, and we don't regulate them. We don't have a secret plan to regulate them or anything like that. But the question is what risks are being kept inside the banking system, which we do regulate and supervise, and what are the relationships between these large non-banks and banks? And we don't have a preconceived answer to that. We just want to understand what are those business relationships like, and what kind of risks does that mean the banks are running? That's all it is.
Thank you, Chairman. I yield back.
The gentlewoman from New York, Ms. Velasquez, is now recognized.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here today, almost noon. Once the Fed is reassured that inflation is under control, what does the path back to neutral interest rates look like?
We've said that we wouldn't reduce rates until we were confident that inflation is moving sustainably down to 2%. I think the question of what is neutral is going to be an empirical question. I think it seems to me it's unlikely that we'll be going back to the very low interest rates of the pre-crisis period. But we'll know that we won't know that until we get there in a way.
And the Fed's dual mandate comprises of price stability and maximum sustainable employment. As the Fed is thinking about inflation and the possibility of interest rate cuts, how are you balancing these priorities with the need to maximize employment?
So over the past couple of years, we've had a very strong labor market and inflation well above target, and that has led us to focus mainly on bringing down inflation. Over the course of 2 years, inflation has come down pretty significantly. There's more work to do there. We're not at our target. We need to keep on that job. At the same time, the labor market has cooled pretty significantly. And so I would say those two goals are now much closer to being in balance. And that means from a policy standpoint, we need to be paying attention to both of them. Whereas for the last couple of years, really, we had to pay mostly attention to inflation.
And Chairman Powell, I have told you that I will be asking for a status update on the Section 956 rulemaking at every future hearing. Since your last appearance in March, several of your fellow regulators have issued a proposed rule. Why did the Fed choose not to sign onto this proposal?
So what we're doing is we're looking at the current state of affairs as it relates to incentive compensation. As you may know, we've had guidance in place now since 2010 for all banks, and we supervise pretty significantly around that. So it's a very different picture than the one that was there in 2010. So we're asking ourselves, what is the situation today, and how do we tailor a proposal to address the residual risk as opposed to what the situation in 2010 was?
Yes. In previous hearings, you said that you need to better understand the problem in order to write the rule. In a speech in June, SEC Commissioner Lizarraga said, and I quote, "It has been well documented that in the lead up to the financial crisis, pay structures often encourage big bets that maximize short-term profits, but ignored bigger, longer-term risks that threaten to take down the entire financial system. Additionally, since your last appearance, several of your fellow regulators have moved toward with a proposed rule. Why have your fellow regulators and Commissioner Lizarraga been able to understand the scope of the problem and the Fed has not?"
Well, I think the quote absolutely makes my point, which is, I think everyone agrees that incentive compensation practices before the global financial crisis were not in a good place. However, we published guidance on incentive compensation, binding on all, well, not binding, but guidance for all banks in 2010, after putting it out for comment. A lot of thought went into that guidance, and now we supervise on that guidance. And so the situation with incentive compensation now and banks is completely different than it was before the global financial crisis.
It's
completely different.
Well, the other regulators have been able to figure this out and you haven't. But let me just say, this is not how congressional mandates work. Of all the rulemaking provisions in the Dodd-Frank, only 148 were mandatory. And of those, only 22 had a deadline of less than a year after enactment. Section 956 was one of them. And I hope that you come to the conclusion that it is your duty to issue the regulation. Thank you, and I yield back, Mr. Chairman.
Section 156 requires either a rule or guidance, by the way. It does not require a rule or guidance. Thank you.
The gentleman from Florida, Mr. Donalds, is now recognized.
Jay Powell was not going to let her get away with that one. He was fighting back.
Let's cover a lot of different areas of ground. According to the Bureau of Economic Analysis, since President Biden took office, the price of goods has continued to outpace family incomes, with prices increasing now 19.3%, while average weekly earnings have only increased 14.6%. So families have fallen behind with respect to their purchasing power, that they're able to go and acquire goods. What role has government spending played in creating this untenable economic crisis?
Close that door, please. Sorry, I can't hear very well when the door's open.
So I'll repeat. That's fine.
No, I heard you.
Oh, okay.
That needs to be closed. So what role is government spending as part of the story? So government spent, we had our rates really low. The pandemic happened and we closed the economy and then reopened it. And I think you saw a burst of inflation, everywhere in the world. And certainly there were many contributors to that.
Do you think that the president in his budget calling for an increase of federal spending, up to upwards of 5% increase in federal spending across the board, do you think that's going to have further implications on stubborn inflation plaguing the pocketbooks of the American people?
It would be inappropriate for me to comment on the president's budget.
The only reason why I would ask Mr. Powell is because obviously the Federal Reserve is having to respond to various aspects of fiscal policy coming from Capitol Hill. Regardless of the president's budget, would it be appropriate in the current environment for federal spending to increase 5%, 10%, 15%?
Honestly, that's a question for elected representatives. We don't play a role in fiscal policy.
Oh, fair enough. Is it the view of yourself and the Federal Reserve Board that fiscal policy does create impacts on the Fed's ability to manage monetary policy for the United States?
We take fiscal policy as a given, and we're not commentators. We're not the Congressional Budget Office or the Office of Management Budget. Whatever fiscal policy happens up here, we decline all opportunities to be commentators on it. We take it as a given, and that's because we didn't run for office. We don't have that job. We stick to our knitting, and the fact that we're independent really depends on us sticking to what our assignment is, which is to deal with things with the economy as it is.
I would argue that the fiscal policy of the United States has given you guys a lot more to deal with, and whatever the various burdens that come with it. Unfortunately, you have to tangle with it, but the American consumer is the one that truly has to deal with it. I'm going to move on. The monetary policy report cites a pickup in immigration as one of the major factors that has improved the supply of labor. However, labor force participation rate remains below pre-pandemic levels. What percentage of the increased foreign-born labor supply, to your knowledge, comes from illegal immigration?
What percentage say it again, the question?
What percentage of foreign-born labor comes from illegal immigration?
I think all of foreign-born labor comes from immigration.
No, illegal immigration.
Illegal.
Illegal,
Sorry,
yes, sir.
didn't get that.
Yes, sir.
I don't know the answer to that.
All right. Well, one of the things that I think will be important to help, I guess, advise Congress on what to do going forward is if the Federal Reserve had some data to that regard to help us make further decisions into the future. Chairman Powell, let me ask you this one overarching question. Obviously, interest rates, if you compare it over the last 15 years of monetary policy, is at an elevated rate. Does the Fed anticipate any possibility of rates being lowered, whether it's 50 basis points, 100 basis points at some point over the next year or two?
So I guess the question really is where are interest rates going to settle out when all of the effects of the pandemic are really done? And no one knows. This is a great discussion to have. But I think my sense, and pretty commonly people think we probably won't go back to that era between global financial crisis and a pandemic where rates were very, very low and inflation was very low and like extremely low. There were major European countries that had negative 10-year bond rates, negative. And that was not the case here, but I don't think we're going back to rates that are that low. We think that things like the neutral rate are driven by slow moving forces, but ultimately you can see the effect. We have, our policy rate is over 5% now, and it feels like policy is restrictive, but not, intensely restrictive. So that suggests that the neutral rate of interest, at least as of now, will have risen somewhat, which means rates will be a little higher.
Okay, thank you so much. I yield back.
Thank you.
Gentleman yields back. We now go to the gentleman from California, Mr. Sherman, who is recognized for 5 minutes. Mr. Sherman.
Palantir 2798, guys.
Would you like us to move on?
Oh, can they just end this? This is
If
pointless.
it's Josh's turn, it's Josh's turn.
Gentleman from New Jersey is recognized for.
Thank you, Mr. Sherman. Thank you, Mr. Chairman. Chairman Powell, you have said that custody assets are off balance sheet, always have been, and do you stand by that?
Sorry, say that again?
You've said that, quote,
Counter at 28 for 2 seconds, then dipped.
always have been. Do you stand by that statement, sir?
I think as a general matter, yes.
The SEC's staff accounting bulletin 121 affects a core banking activity, custody. The specific bulletin requires banks to put digital assets held in custody on their balance sheet, effectively keeping banks out of the market entirely. Have the Fed and the SEC had conversations about the impact of SAB 121? And just want to get a sense of your thoughts on the policy, please.
So we, as you know, I think we don't comment on the SEC's policy. They don't comment on our policies either. So I know that I knew you were going to SAB 121 on that, but honestly, it's the SEC's business, not ours.
Thank you. Last month, you said that when evaluating inflation data, you consider whether wage growth is outpacing productivity. From 1979 to 2019, middle-class workers' productivity grew about 60%, while their wages grew by about 16%. Do you consider this historical gap when considering whether to hike rates on families obviously struggling to make ends meet?
So we're looking at inflation and we're looking at maximum employment. Those are our goals. We don't really have the ability we don't have a bunch of different tools for things like what you're talking about. So really, it's just those things. Of course, we're very well aware of longer run trends like that. You have to also include benefits, though, in that analysis, which does close that gap quite a bit. You just mentioned wages.
I appreciate that. Thank you. Mr. Chairman, yesterday, the Director of National Intelligence said that, quote, Iranian government actors have sought to opportunistically take advantage of ongoing protests regarding the war in Gaza. End quote. They have observed actors, quote, observed actors tied to Iran's government posing as activists online, seeking to encourage protests and even providing financial support to protesters, end quote. As a member of the House Select Committee on Intelligence, I'm equally concerned about our adversaries meddling in our financial system. Can I have your commitment, or if you can discuss the work, if you're working with other federal agencies to investigate and address foreign interference channeled through our financial institutions?
So we do take part in many of those things, especially at the staff level. And as you know, there's a lot of focus in the intelligence community, and it's very helpful to the banks, the commercial banks, and to us. But we're certainly very focused on those issues. We've got a strong team. Of course, you're never able to sleep on cyber risk, but we just keep fighting it.
I would like to switch gears to the discount window, please.
All right, we're ending this. This is getting boring, guys. If you really want to watch it, I'll put the link in the chat, but he's just not saying anything that's important or relevant. We've already heard yesterday's testimony, which was the big stuff. And then today, the biggest thing he said was that he feels kind of what he said yesterday, but he kind of was a little bit more explicit that he personally, speaking from Jay Powell's perspective, the labor market is weakening enough. And then he said, as a result, if we feel the labor market weakens, we can take appropriate measures to cut rates. And he said he personally feels the labor market is weakening. So when he's with his other Fed presidents and they're deciding if they cut rates or not, I think he's going to be one of the advocates to say, hey, guys, the labor market's weakening. And if the labor market's weakening, we need to probably consider cutting rates. So I think that was the biggest tell sign, and seems kind of obvious that they will be engaging in that rate cut in July as long as CPI is good on Thursday. Pound here, 27.87. So we hit 28.01. We got hit with some resistance. There were about 30,000 shares waiting to be sold at 28. So kind of got over that hump and then came right back down. 27.88 on Pound here. Tesla showing incredible strength. 264. It dipped to like 257 at around 11:30. 49 minutes later, it's at 264. Bill Gross did call Tesla a meme stock yesterday. So we did get some of the heavy hitters in finance saying that this Tesla run has not been reasonable, but Tesla doesn't care, and it continues to move higher. Now a crack above 265 and a potential crack to 268, making its way to 270. That would just be, I mean, if you think this is unbelievable, getting to 270 would just be incredible. This is the, I believe, 8th green day in a row if Tesla closes green. And so it's pretty amazing. $842 billion market cap now. Again, added about $320 billion over the past 3 weeks at this point. Tesla maintains the momentum. And then NVIDIA not slowing down either. 134.58, up 2.44% on the day. We're seeing NVIDIA back into this 135 range, which is really nice for NVIDIA. It peaked at 140 3 weeks ago, back down to 115. Dip got eaten up. Now it's at 134. S&P touched 559 at one point, I believe. Right now here at 557.58. Oh, no, it hit 558. 14. So that was the high, not 559. 558.14. Then it came back down. Now right back to 557.96. Tom Lee just put out a note from Fundstrat, and they are bullish on CPI coming out tomorrow. That's going to be out tomorrow. I'll be live 8:20 a.m. They're saying, hey, we think CPI is going to be below 0.25% year over year. This will trigger rotations in small caps, industrials, financials. Remember, financials are going to win if rates come down because they have a lot of loans on their balance sheets that are going to not be as underwater if we lower rates. And laggard fangs, those are the Teslas and Apples of the world. So Tom Lee thinks we get less than 0.25% tomorrow. They're thinking about 0.21%. If that's the case, maybe the market's front running that right now. Maybe that's why Jay Powell says, hey, I think, we can cut if we think the labor market weakens. And if CPI continues to come down, then that Goldilocks zone does establish itself for the Fed to cut rates. And that would obviously be a very good thing for broader equities, especially if Q2 earnings ends up doing well, which is going to be important. Meme stock. So GameStop is up. An insider bought yesterday. I think that's why people are excited about GameStop, 25.60. And then Chewy is up as well, 3.55%. There's something else about a Chewy insider that I was reading about a little bit yesterday, but I believe Chewy and GameStop at this point are moving kind of congruently because we still don't know if Kitty got out of GameStop for Chewy. That's my hypothesis. Maybe somehow he has $500 million and he split 250 in each of these. But yeah, both of them are getting higher today. Also, the call options on GameStop are pretty incredible. There's been I think like $2.5 million worth of calls yesterday were purchased, and this morning a ton were purchased. So we did see a decent amount of call option activity, which is leading to some more bullish activity in the stock itself for GameStop and Chewy. Tesla right here, 263. Robinhood taking a little bit of a dip with Bitcoin. Bitcoin now falling about 0.5%. I put in my order for Robinhood. I don't know if it'll fill. It hasn't filled yet. It would probably fill at like 2180, but let's see if we get there. We dipped to about 2210 and then we bounce right from there. Again, that low 22, we bounce off that pretty much every time we get there. And if we go below 22, I think it's a buy the dip. So we'll see if that happens later today. QQQ did touch 500 on the NASDAQ, 499 right now. Tesla 263, Rocket Lab 511, Meta 535, Snowflake down 2.29%. Again, all the SaaS names are down at this point besides Oracle and Palantir. Palantir at 27.77 on the day. So that's what we got. SoundHound, I don't know what the catalyst is for SoundHound, but that one is up as well. 13%. This one a little bit more of a meme-ish stock as well. So not sure why that one is up, but that one is up. Let me do a quick search on Sound. What's the ticker symbol on Sound? SOUN. Let's see if there's anything interesting. SoundHound chat launched in European markets. Significant increase in AI, I think they reported. Yeah, it seems like they launched their AI chat voice assistant with ChatGPT. What that means is like GPT with some fancy wrapper around it, basically, in Europe. So I guess it's up because they launched AI products in Europe. I don't know if that's enough for why. I don't know if that's a good reason for why it's up, but seems like that's why it's up. Amit, have you done any DD on SoundHound? Do you still think they have a moat? No, I think SoundHound's a meme stock. I don't think it's that exciting at all, to be honest. Their revenue is like $80 million a quarter. Like, it's just not. Could it go up from here? Sure. It still is up a lot year to date. Remember, the stock was in the low single digits. It was at $1.06 back in November. It went to $10, 10x. Now it's at 4.6. Basically, still up 300% over the past 6 months. I don't think the earnings necessarily justify it. And I don't think there's a moat, but people got excited because Nvidia invested $2 million or something, and that's why it ran a couple months ago. All right, that's pretty much it, guys. I mean, it's a green market. Jay Powell said pretty much everything that the market wanted him to say. 558 on the S&P. It's a new all-time high. So markets obviously liked it. AMD is breaking out today at 182, up 3%. Tesla, again, still maintaining these 260s, trying to get to 264. And then the broader S&P here at 558. We'll see what happens with Palantir throughout the day. Palantir looks like it wants to break out to 28, but it keeps getting rejected there. Probably healthy that it stays in this 2780 range and kind of consolidates here. But if there's enough momentum and buy side pressure, we could see a breakout. Again, on earnings. Earnings is really going to be binary, dude. You either have puts on earnings and you make money, or you have calls on earnings and you make money, but it's going to happen either way. Like this thing is, I don't think this thing is staying flat. I think it's up 10 or 20% or it's down 10 or 20%. I'm probably not going to play earnings at all. I think I don't know. Like, I think it's going to be bullish, but it's hard to say you're going to have some massive growth given the stock's up 20% in the month, unless the guidance is there. And if the guidance is there, I'll be very happy because then we're probably past the 30s. But if it's not fully there, we might take a bit of a breather. And the thing about taking a breather is they would have to not raise guidance at all. I think, we're still guiding for 21% year over year. If Palantir just keeps it flat, maybe that lessens the fall. But if they if they leave it flat, maybe that increases the fall 10, 20%. If they raise it slightly, which is what they did last quarter, people forget they raised it by like 20 million, which is not a lot. But if they raise it slightly, maybe that helps. But I think the market is expecting them to raise it a bit more, which is why we've seen this premium. But you never know, man. Maybe the market knows something that we don't know, and maybe this is not all retail FOMO, and they are expecting something different about Palantir. They're expecting a government deal. They're expecting broader growth. They're expecting AIP monetization. They're expecting something that is different, and either Palantir is going to live up to that expectation or not. If we consolidate from 25 to 27 post earnings, I don't think anyone can complain. That's a really good place to be. If we consolidate at 26, that's a great place to be. And then we'll wait till Q3 to make the next leg up, hopefully into the 30s. We don't have a date yet on Palantir earnings, probably in that first week of August. We'll see what happens, but still don't have a date yet on when earnings are going to happen. Cool comment guy says Palantir earnings are going to be fireworks. Think the customer count is going to moon, and they are going to be looking to break 3 billion revenue by year end. So if they get to 3 billion in revenue, they're basically raising revenue by 300 million. So that would be a growth rate increase of 15%. Which would put them closer to basically 27-ish% year over year, if I'm not wrong. So, because they're projected to do 2.6, they would be doing 3, if you're correct. That means they have to raise revenue expectations by 15%. It's very possible. I think it's very possible. I think it's just a question of, do they choose to even say that in Q2, or do they wait until Q3, Q4? That's going to be the question. And if we don't see revenue growth expansion, but we see customer count increasing, then the signs are very obvious, just like what was happening at $12-15. We saw customer count go up. We didn't see revenue go up. Eventually revenue growth caught up to it. The monetization will eventually come, but as long as we're getting the customers, that's the most important. Cool. So that's pretty much it in the market. Let's do word of the day, and then we will end it out. The J-Powell testimony really, it wasn't that good today. Even remember one of the senators who literally said, this was boring today? Like, outside of one sentence about what he thinks about the labor market, really did not get anything that interesting. And would you invest in Rivian? No, because Rivian's already ran up at $9. The chat knows I was thinking really seriously about it, but I couldn't get through the cash burn stuff. If I did, I didn't expect Volkswagen to put in $5 billion, which kind of alleviated some of the cash burn concerns. But the cash burn is why I didn't put it in at 9. At 16, now that it's ran up 50%, it would be really hard to put in money right now. It could still run though, but it's not the most exciting given it's already run. Okay, word of the day. Marmoreal. The hell is this?
Marmoreal.
Okay, marmoreal. Characteristic of or like marble. The ancient ruins included a marmoreal floor, still shining brightly despite the passage of centuries. Your complexion is so smooth and pale that it looks marmoreal under the soft lighting. Could you imagine saying this to a girl? Your complexion is so smooth and... Did I say smoth? Oh my God, I said smoth. Yo, I actually said smoth. Goodness gracious, dude. Is so smooth and pale that it looks marmoreal under the soft lighting. I feel like she would be like, are you calling me fat? That's basically how it would play out. All right, so marmoreal. That is the word of the day.
Marmoreal.
Interesting word, but that's what we got. All right, I'll see you guys at 3:45. We'll see what happens with the broader markets. J-Powell testimony, nothing that crazy. Overall market's doing well, and we'll see at 3:45 what ends up happening from there. All right, thank you, everybody. I'll see you in a few hours. Have a good one. Bye-bye.